And hopefully a lot more fabulous. Happy birthday, Niraj.
Thank you so much. Thank you so much, Samina. And thank you, all of you, for this wonderful gesture. Means a lot, really. So thank you so much.
Yeah, we do have some cake, and that we promise will be 0 calories. But for now, of course, I am missing my mic.
But I tell you, there is no 0-calorie cake, Samina, I must tell you. I mean, most cakes have some calories, but hey,
yeah,
you know,
you can still enjoy it.
During the festive season,
Yeah.
it's great to do that.
So yes, we have Niraj Shah, who turns a year wiser, and of course there's a lot more for you as we get on this journey. But thank you for being part of the team. I'm so glad to be working with you.
Likewise, Samina, and once again, I mean, of course, it's just great to be a part of this team. We are not even a year old, and it's looking very fabulous. We are hopefully making a mark, but just this small gesture really means so much to me today.
Thank you. So that is, of course, the big breaking news this Friday morning. But now back to some other action in the financial markets. The markets globally, of course, not looking great. It's been a tough morning for Asia. Wall Street, of course, was mixed. Tesla is the biggest story that we will talk about in a minute. But just to take you through what's happening across Asian markets before we move on to Wall Street. Asian markets are in consolidation mode. Some bit of gains are being seen in China. Remember, Japan is slightly lower, and they go into their general elections this weekend. So it's sort of a big trigger that those markets will be tracking, and most Asian equity investors will also want to closely track the outcome of that. Well, apart from that, Wall Street was mixed. The Dow didn't have a great day. The S&P 500 and the NASDAQ managed to do okay. So you had the Dow that ended lower, the NASDAQ doing okay in trade, up about 1%, almost 1%. But remember, after having a strong winning streak for the last 6 weeks, it seems like the Dow could be taking a break this week. It's already down 2% this week so far. Very unlikely it's going to recover those gains in Friday's trade, but who's to tell? Apart from that, you had some economic data. I'll quickly take you through that. Sales of new homes have increased to its highest level in the last year and a half in September, up 4.1%. And initial claims to state unemployment has actually dropped. But what stood out for me was that the number of people collecting benefits in mid-October was the highest in nearly 3 years. So that's what you want to track. The data can be viewed as a glass half full or half empty. The good news for Wall Street investors is, or equity investors is, that there's been a slight cooling off on the 10-year Treasury, which was sort of playing spoilsport for equity investors on Wall Street. Tesla was the big story, 22% higher, its biggest gains in over 10 years. And this was because the management commentary, extremely promising and convincing about the outlook. They did add a significant $140 billion in market cap in overnight trade. Well, that's what we have in terms of equity. Oil is doing its thing. It's zigzag depending upon what sort of concerns rise and subside in the Middle East. Gold is gained. Silver is sort of consolidating after a big move this week. Palladium is actually up very sharply. It's up 9%, largely because 40% of the palladium supply comes in from Russia. And regarding some supply concerns with Russia, it seems like palladium's been on a bit of a breakout this morning. So that's what we have. I think the star of Wall Street was Tesla. You're a big fan, so why don't you tell us what you thought? Because the earnings weren't very impressive.
Yeah, I mean, so here's the thing about Elon Musk, right? Elon Musk says that his best guess is that vehicle growth will reach 20% to 30% next year. The prediction was about way ahead of the analyst estimates of 15%. That brought about the need for the stock to move up 20 to 22%. And that adds a mere $34 billion to Elon Musk's kitty. So, you know, that's quite something.
$140 billion to investors worldwide.
Yeah, so it's just quite stunning, really, as to what happens when Elon Musk makes a statement. And it just shows the power of the guy, of course. I mean, I admire the guy for more reasons than one, but be that as it may. The only thing is, the other small piece of news, Samina, I know you spoke about it, but IMF saying that Chinese stimulus is insufficient to curb deflation risks, and the Chinese municipal debt market, record defaults hitting that 800 billion market. So all is not well there, despite the fact that they've done a little bit of a stimulus. And I wonder if that brings metals into focus today.
And they've not really been too enthused for whatever it's worth, right? You've seen very small gains being eked out. And anyone who is talking with a tactical gain in China as well, that ride may not be taking off anytime soon. So that's what we have for Asian markets. But of course, the action is on the US markets. You've got 2 weeks to go for the election outcome. Anurag Singh, managing partner of Ansit Capital, joins in. Anurag, good morning. Thanks for joining in. Anurag, 2 weeks to go until the presidential election outcome. Is this going to have a material impact on the direction of equity markets for Wall Street?
Samina, morning. Happy Friday. Also,
Anurag, happy birthday to Niraj.
Yeah, that too. I would have waited if Niraj asked a question, but yeah. So Niraj, happy birthday.
Thank you so much.
By the way,
Anurag.
Yeah, I heard of the 0-calorie cake. By the way, in my last visit to India, I saw so many of these sugar-free sweets. Like I refuse to believe there's anything called as sugar-free sweets. By the way, so I don't think there is any 0-calorie cake. But yeah, still do have something. Right,
Thank you, Anurag. Much appreciated.
Yeah, and so Samina, look, elections will have an impact in the sense that, they will have or they will not have. Market is pricing in a Trump victory. But by the way, the key here is that the Republicans are likely to regain the control of Senate. And if Senate goes Republican, then it's a logjam either ways, even if Democrat win. And the president pretty much becomes a lame duck president. They can't decide anything. Even the cabinet has to be approved by the Senate. So that kind of brings the checks and balances kind of for the government. So that's a view on the elections. Right. But, at the same time, I think there were quick data points. I heard you talk about the unemployment number at 1.9 million. That's exactly the kind of number we had before 2020. So it's not it is all coming back to normal. It's nothing, there's nothing abnormal about it. It's not a panic. The recession numbers are like 3 million, 3.5 million or 4 million, right? 2 million unemployment claims continuing basis. It's pretty much exactly back to where it should be. So I think all otherwise looks very good, in US, except that the broadening of the rally has to happen outside of these 7 stocks. So 7 versus 493, the typical battle that we always talk about, that's underway. And that's why you find that the last couple of months, the equal weighted index is rising more than the overall S&P index because the big 7 are kind of taking a big break. Samina.
Right. Anurag, what are you making about all this talk about more money moving away from India into China? We did get some data on fund flows a few weeks ago, and it seemed like Chinese inflow is actually not coming in at the cost of India. What China is getting is incremental flows that would go into Europe that are actually finding their way to China. Do you think the debate holds and not strategic? Because I'd like to believe that India still is a strategic long-term preferred bet to China. But tactically, over the course of the next 3 to 6 months, do you feel like incremental flows, or we may potentially see outflows that may make their way either into Wall Street or China, largely on back of valuations?
So, Samina, big picture first. Here is the big picture on emerging market flows. 10% of the ETF allocation goes to emerging markets. Of this 10%, about 20% is India weightage. So, which is where, if the $100 is invested, in the US markets, about $2 of that finds a way to, Indian markets. Indian GDP is about 3.5 trillion. So it's a shade below the normal weightage. But look at in the last few months, China had dropped down to almost like 25%. For the size of Chinese economy, I think that number was too low. So it is good that the Chinese government has kind of woken up to this reality and taken a notice. Now, to your point, look, there are 3 challenges. There is a monetary problem, monetary stimulus, there is a fiscal stimulus, and there are structural demand creation problem, right? China is facing a demand scarcity. Now, they can solve for the monetary problem, they can solve for the fiscal problem. And I think in the short term, that's all investors needed to know, that they're not there to kill capitalism and it will thrive. So I think a re-rating was waiting to happen from a 9 PE to a 15, 16, 17 PE. So I think that will happen. I don't think India will lose too much in the sense that, maybe a 20% weightage in MSCI can go down to 18. I think that's marginal. But beyond that, it's not that, the money is totally gonna change places because world is a little more cautious on China as well. But that said, it's not that there's nothing to jump into the Indian markets as well. The markets have really taken a big leap in the last 3 years when the world was under pause. So I think it is India's time to take a bit of a pause now, I think, which will be very healthy.
Just wondering, Anurag, is this at worst a pause, or the worst could be a substantial decline because the street is divided there when it comes to India?
So Niraj, I think you've been a veteran in the market for so long, and I think my sense is we've all seen 2008, and we've seen the great stagnation between 2008 and 2018 and 19, right? Where every time the earnings kind of almost grew by what, like 3, 4, 5%. That's about it between those 10 years. So I think I have more reasons to believe that the earnings, Nifty earnings, let's say, that rose from something like a 430 rupees to something like a 950 or 1000 from 2020 to 2024. That's a CAGR of 22%. Now, that's not something which is sustainable. It all happened because, the bank earnings peaked, technology got a big push, government spending came in, and I think even the consumers fired because of this stimulus pre-COVID, post-COVID, the revenge buying by the consumers post-COVID. So I think all of these industries kind of peaked at the same time. But I don't think, and I think it's pretty evident if you just see numbers from Bajaj Auto, Unilever, and Ultratech, I think the economy also needs to slow down. I think if I were to just leave you with a big picture thought, look at the nominal GDP growth of India. It is just about 10% for the last 10 years. So since 2014, the nominal GDP is growing at give or take 10% average. If that is the case, how can earnings be growing at 22% beyond a temporary blip, right? So that's my broad thesis, Niraj. And I think to the investors, message is, if you buy anything now, next 5 years going to be very, very muted. It has happened in the past. It will happen right again. I have no reason to believe the earnings structurally have gone to a 15 or 20% CAGR rate, especially in a low inflation environment. Niraj.
Noted.
Thank you, Anurag. Great talking to you this morning. Yes, the ride may get a little rough, but India still remains a great story structurally, and I think there is a clear consensus on that from local and global investors. Well, let's take check of how volatile it's been for us, and no one's arguing it's a tough market. It's definitely a very tough market for traders. Investors, of course, on a buying spree is what I'd like to hope. In terms of what we had for trade yesterday, it's been the fourth straight day of losses coming in for D Street. The Nifty struggled again yesterday. While the fall was not big, any sort of recovery is missing and has been missing all through this week. We shut shy of 24,400, which was turning out to be an important level of support in terms of trade. That hopefully should get recouped in today's day of trade. Well, the Nifty itself, remember, is down for the last, is down 7% all through October. We've traded in a 600-point range all through this week. Of course, we started the week closer to 25,000. We are closing out the week closer to 24,400, at least this Friday morning. The Nifty is down sharply for the week as well. If you can quickly get the graph up for the last 4 trading days and get a sense of what happened in the markets. It's been a tough ride, like we said. Any positions on either side seem to be getting sold or bought into. That's how the Nifty has been this week, down quite sharp, 2.2% lower is what we've seen. Well, banks did provide their support in trade yesterday, and they've been trying to do that. But again, at higher levels, we've been seeing selling. It shut close of 50 shy of 51,500, so that was where we actually ended trade. HDFC has become the star, and that's what I think most investors who've been waiting for that stock to sort of outperform would be enjoying the current rally. Along with HDFC, SPI also had a pretty pleasant day. Broader markets gave up gains towards close, so while they started the day off pretty well with significant outperformance, by the time we ended trade yesterday, the small and the mid-cap stocks also ended in the red. The underperformance on the Nifty was led by consumption names. I mean, this has been historically a defensive pack, right? Consumption names are supposed to be stable, steady. Some argue calling them the Rahul Dravid of this trade. but that's not coming through. You had counters like HUL that got punished on numbers, ITC declined even before the earnings came through. Extreme earning reaction will continue with the broader markets, and traders do believe that the Nifty remains in oversold territory, but any sort of material recovery is still a little far-fetched for now. FIs continued to sell. They sold again yesterday to the tune of 5,000 crores. Now, of course, having sold over $10 billion. So we are closer to $85,000 of sell by foreign investors in the month of October alone. So that was the market. It's been a tough day. I don't know whether we can call it a Friday cheer, but Niraj, you want to tell us, are we being hopeful of a Friday cheer? I think at best we are going to get is consolidation with maybe a slight positive uptick.
Yeah. I mean, somehow it seems, Samina, that I don't know how you feel about it, but sell on rise seems to be the easy theme given the growth scare. Almost everybody thinking that this is the easiest thing to do. Yesterday, too, the small caps, the way they came off, as Samina said. So therein is a problem. I think BFSI is now starting to feel the heat of lower growth and slippages as well, because while HDFC Bank may have done what it has done, and probably we'll see ICICI Bank do that, but IndusInd's numbers, and we'll talk about that in detail, leave a detail or two about what could be happening to some of those BFSI names as well. We've seen asset quality issues crop up, really, and therein lies the problem. Today, for example, I saw steel stocks as well in focus, Samina, because brokerages have opened some massive downside watches on likely weaker numbers. So that's something to see. In a nutshell, somehow it just seems that while tactical bounce back are possible, it's just very, very difficult to see higher trending markets under the current scheme of things. I mean, yesterday, Samina, talking to Sonal Verma of Nomura, and while they have put out a note saying that Q2 is weak, their assessment seems to suggest that Q3, which is the December quarter, despite festive season, will trend lower than estimates. So we are, at least the economist's view is that the growth is not looking very good.
So very contrary to what managements have been telling us, right? The optimism was there. In fact, I was talking to Tata Consumers a few days ago, and they very clearly said that early signs are in. So they have started off the festive season quite well. Now, the only hope is that that sustains, but not sure what's not working for the macros, because it all seems like everything's moving in or in the right direction. You have a whole bunch of earnings that will be announced today. So you've got the likes of Coal India, GSW Steel, BPCL, Bank of Baroda, Bandhan Bank, Hindustan Petroleum, IDBI, Inox Wind. So lots and lots of companies, Yes Bank, and of course tomorrow you'll have the likes of a Yes Bank and ICICI Bank report numbers as well. But let's take you through a few reportings that we had in terms of earnings. I don't know how we're reading ITC, but the revenue seems to have seen a jump. It's the first consumption stock FMCG counter that has reported a double-digit jump in revenues of about 17% and 19,327. Profit, though, keeping in line with the street, is only up about 3% this quarter at 5,778 crores. EBITDA has increased 4.9. Margins have declined substantially for ITC, down about 370 basis points at 32.8 versus 36.5. Raw material cost has been the biggest concern for FMCG and consumption stocks. Prices of coffee have risen sharply, and including tea. But of course, in the case of ITC, it's coffee that's impacting the company. Coca and crude oil has also impacted the way margins are playing out. They don't seem to be in a position to pass on a price hike, but we will understand whether in the next couple of quarters a slow, gradual price hike is what would be undertaken in order to make good the lost margins this quarter. ITC's total expenses also sharply risen 21%. So those two factors are the key reason why you've seen a decline in bottom line, or rather bottom line not keeping up with the pace of growth on top line. Shares of ITC ended 2% lower, but what you want to remember is year to date, ITC is only higher by 2%. So it's actually not had a good run. It's not moved up very sharply. I think 530 is the peakish that we had seen a few months ago, rather in September. But since then, the counter has been on the sell. Well, along with that, what a disappointment from IndusInd Bank. Profits have dropped a significant 40% to 1,325 crores. Net interest has grown 5.3%. Provision and contingency have seen a very big spike. So one stock that's definitely on the sell side this morning is IndusInd Bank, down up 87%. Gross NPs have risen 2.11. Net NPs have increased 0.64. I think, Niraj, this is what the concern is. And I think the rest of the year, it's going to be the boys versus the men, right? HDFC Bank, good asset. And maybe they will hopefully start getting rewarded for the kind of asset quality they have. I mean, look at IndusInd Bank. These are the stars of the last few quarters, and now a sharp decline coming in asset quality.
Yeah. I mean, you nailed it actually, Samina. Provisions, 73% uptick is something. And, the City note laid it out very well, that slippages are elevated due to a clutch of factors, not just one. The MFI book, two-wheelers, tractors, merchant advances, they have cut earnings by 18 to 22% has Citi for IndusInd Bank. So they've maintained the buy. But look at the target price slash from 2010 to 1630. And you're right, exactly right. Maybe the street will now separate the men from the boys or the girls from the women.
You've got to be so careful when you say these things these days.
Especially I have to. I completely agree.
No, and I think the industry as whole is going through a significant change. Remember, while the economy seems to be in good state, the competitive intensity for deposits is a worry. So now they're not just competing amongst their peers, they're competing with a new asset class in so many ways, right? With all this talk about financialization. And we've seen that capital market players, the numbers are phenomenal. You look at anything in the banking place, it's truly a worry. And I think this comes back down to what Sonal Verma told you. The economy may not be in great stride in the next quarter.
Yeah, doesn't look all that great. So, okay, so those were Samina's.
I've got two, but you can go and then I can come back.
No.
So just another one,
yes,
IEX, I think those numbers were really good. So only because IndusInd was such a disappointment, I feel like it's only right to give out a good stock call this morning. So profits have jumped 28%, revenue has grown 28%, EBITDA has surged 30.5%, and margins have also improved. So I think IEX could be on the buy side this morning, only because those numbers are actually pretty good, I think.
Yeah, well, okay. Then let me take a leaf from that. Two stocks, Dixon and Nippon Life. So good numbers, and since we are talking about capital marketplace, pays to highlight Nippon Life as well. But first one is Dixon Technologies. Revenues were up 133% at 11,534 crores versus 4,943 crores. Now the sticklers would argue that margins are at 3.7% versus 4%, and there is a bit of a contraction there. But I think it's kind of in line with what the management has been talking about. The bottom line performance is pretty solid at 263% uptake, or nearly 4x uptake, right? Nearly 4x, or not quite there, 3.6x or thereabouts. So the point about Dixon is that they are now batting for revenue growth, and you've got to reward that, I think. So I would be surprised if the street doesn't reward this stock positively, despite the fact that it's an expensive one, because the reportage has been very solid. Nippon Life, very good numbers too. Total income rose 45.6% at 692 versus 475 crores. And the net profit rose 47.3% at 360 crores versus 244 crores. The estimates were about 313 crores. So that's the second one on my list. I'll be surprised if it doesn't get rewarded positively. And on the flip side, I'll avoid talking about the gas names because Mihika is going to talk about that in detail. But RR Kabel left a bit to be desired. I mean, we've seen this happening now with Polycab as well, that the numbers were a bit sluggish. Look at RR Kabel. Revenues were up 12.5% at 1810 crores versus 1609 crores. So there, maybe it was okay, but the margin cut has been strong. I mean, margins are at 4.7%. versus 7.5%, as a result of which the net profit is down 33% at 49.53 crores versus 74.1 crores. So RR Kabel very likely a stock that will react. I think the margin performance is the one that will really hit the stock badly today, 4.7 versus 7.5. So do watch out for this particular piece. Could hit RR Kabel today. Top three on my list.
Couldn't add Finolex to that. Very, very weak numbers. And it's surprising because the stock has been an outperformer in terms of reportage in the last few quarters. They've guided for a 20% revenue growth. This quarter, that's not reflective in those earnings. Management, of course, in the previous quarter had indicated that there will be blips along the way, and their agri book is what was struggling. Now, whether that is what is happening this quarter as well, we'll understand when we talk to them. But just to take you through it, their profits are down significantly, 60% lower, coming in at 40 crores. So I don't think they were anticipating this to say the least. Revenues also, while we're looking at a 20% YOY growth, I mean, this is a 6% decline that we've seen in their revenues, coming in at 828 crores versus 883. EBITDA, for obvious reasons, is also lower at 90%. Margins, and I think we need to delve a little more into this, have come in at 1.3 versus 11.7. So I'm not sure what's gone wrong here, Niraj, but a margin dip from 11.5 to 1.3, a decline in top line, a decline in profitability, obviously because your margins have taken a huge hit. I don't know whether there is an exceptional item here, whether there was a one-off impact on cost, but for whatever it's worth, those numbers look terrible, unfortunately, and the stock will have to deal with the pain in today's day of trade. Another one is Aarti Drugs. We've been talking about how there is a little bit of a recovery in place for the sector, but the numbers still down. Net profit is down 11.6%, revenues are down 7%, EBITDA down 12.5%, and margins have declined slightly.
A clutch of bad news though. JSW Energy was weak because margins cracked from 57.7 to 52% because and the estimates were 71.5%. There is an uptick in profits on JSW Energy only because of a deferred tax liability, so that one will be weak. VST Industries, margins at 18.8 versus 22.6. That's the other one that will look slightly wobbly. So watch out for this one. Then some stocks in news, and Shriram Properties. ED is conducting searches at the office premises in Bengaluru and Chennai. The company said there's no involvement in the alleged matters under investigation, but Shriram Properties is the one, not Chalet, but Shriram Properties. No, okay. So Chalet Hotels is good, by the way, so keep that in mind. Chalet Hotels is actually a pretty decent set of numbers. There are one-offs which are impacting Chalet, but Shriram Properties is the one which is going to be weak. And just before I go to Mihika, some positivity. Let's not all be negative today. So some positivity. Samina highlighted ITC, but the revenue growth numbers looked okay there. Godrej Consumer and Radico Khaitan, two consumption names, wherein I thought wasn't bad relative to estimates. Revenues in line with estimates, margins exactly in line with estimates, net profit exactly in line with estimates. Here's one company, Godrej Consumer Products, which is not disappointed. And then there is Radico Khaitan, wherein revenues have up 9%, but margins expanded, as a result of which net profit up 25%. So maybe some relief for consumer names today. Let's wait and watch. But Samina, I'll tell you. Sorry, yeah.
Just one quick one, because we've actually thrown out quite a bit of bad news this morning, but you had a strong set of numbers from Nippon. And this comes
I mentioned that.
Oh, you did. Sorry, pardon me. Okay, so that's a good thing.
Nippon Life was a good number.
We've got lots of earnings. A couple of the stocks that will be reacting to earnings today are in the F&O ban. But the big story this morning is that the Petroleum and Natural Gas Regulatory Board of India has proposed a change in the way city gas distribution companies operate, which could remove the exclusivity clause for existing operators. There are 73 networks in the country through which gas is distributed, and the regulator has said that these will be common carriers, and this means that any entity can and will be able to use this infrastructure to provide CNG services. Mika, first tell us what the news is and which of the listed companies are going to be impacted by this.
Yeah, we have gas stocks that, could be under pressure, Mark, stocks like Gujarat Gas, GAIL India, Mahanagar Gas, Indraprastha Gas, Adani Total Gas, and IRM Energy. Now, the Petroleum and Natural Gas Board has issued notice to these city gas distributors and more, and has the notice declares 73 of the country's networks as common carriers, which proposes that there would be no longer any exclusivity with the operators, and open access will allow other companies to enter and provide CNG services. When you talk about which of the listed players and how many of their geographical areas have been issued notice, well, we have Gujarat Gas at 20, GAIL India at 5, Mahanagar Gas at 3, Indraprastha Gas at 2, Adani Total Gas at 3, and IRM Energy at 2. Now, what the board has said, they've invited these companies to present their views on the notice, and the meetings will take place between November 4th to November 20th, 2024, after which the board will make a decision and then thereby initiate a public consultation process. Now, a little bit of historical context, the notice follows a high-level committee that was formed by the Petroleum and Natural Gas Regulatory Board some time back, and this committee was formed to address competition and ensure a level playing field in the sector. When you talk about the potential impact on the networks being common carriers, well, increased competition may reduce profits for the current operators. Potential increase in regulatory burden is also one of the negatives, and also a potential delay in the network expansion. On the positive front, while higher competition could lead to lower prices for the consumers, it could also have easier access to other companies for infrastructure, which can lead to higher gas penetration. Provision of equal opportunities to all entities in the space could also come with this notice. It is to be noted that the matter is currently under consideration and could take significant time for any actual regulatory action to come by. But yeah, we could see some sentimental negative impact on gas stocks, and this actually marks the second negative development for the space after the government cut the APM allocation to the sector as well.
We can't have any analysts on the street reacted to this. I have a view on this, but just before that, I wanted to know: has anybody put out a sense of how big a negative could this be in numerical terms?
No notes coming in yet. We did have an IFL, view saying that this is a negative development, considering the kind of the kind of negative flows that we've seen this month. But we have to wait for an actual declaration to be announced, because at this point this is simply a consideration. Okay,
Mika, just stay on. I don't know how Mika wants to respond to this. I mean, I don't know how you think about this, but here's the view. I think when the first set of conversation points around this came out, the belief, and Mika, feel free to counter me, Samina, same, but I'm just asking you that when the first set of points came in, I think the view of some of the CGDs that we had spoken to then also was that if the infrastructure network has been laid, has gotten depreciation benefits, has gotten a low cost benefit already set, it's very difficult for a newcomer to come in and set up an infrastructure which can be competing on costs with the incumbent. And therefore, hypothetically, if MGL has set up this whole infrastructure, well connected in Mumbai, etc., and stuff like that, can another one come in? I mean, Mumbai may not be a part of the 73. Yeah. What I'm saying is that a lot of people are saying that the incumbents, which are there in these circles, have a head start and a big advantage over newcomers coming in. So sure, in theory, there is increased competition. In reality, it may not be as bad as the news makes it sound to be.
Yeah, because it's not barriers to entry are quite high, but yeah, I think Mika would have better perspective. Mika, you want to jump in on that?
When the committee was actually formed to address competition some time back, we did have a city note saying that this could lead to industry consolidation. And in terms of risk for gas companies, well, it also depends which segments that these gas companies are currently operating. What the brokerage had said back then, that for MGL and IGL, they face less competition risk, but Gujarat Gas could face higher competition risk due to the heavy reliance on the industrial sector. And when we see the notices issued yesterday as well, Gujarat Gas had the highest number of geographical areas to which the notice was issued.
Noted. Okay. Well, let's wait and watch how it shapes up. Maybe there's a sentimental downtick today. Maybe there's an actual downtick today. I may be wrong here as well, but let's wait and watch. Thanks a lot for that, Mika. Thanks for putting that into perspective. Big news early morning, and good to get that perspective. I hope viewers, you benefited from it. Now, let's go across to Agam to benefit from how he thinks about the derivative space. Because Agam, I really want to know, how have you thought of the cues, considering the fact that it seems that it's a sell on rise market? That's the easiest thing to notice.
Yeah, because it's getting really hard for every time you've gone long, the markets have sold into, and yes, it clearly is showing some signs of a sell and rise market. And at the moment, we are not seeing any encouraging signs for the benchmarks, the Nifty and the Bank Nifty, well, in terms of advances. In fact, they're not even being able to clear the most near-term, resistances. But as far as the implied open is concerned today, again, looking at a very quiet one. This is for now going to be inconsequential, because a lot of things change through the course of the day based on the kind of earnings that we see. Nifty futures didn't see any change in open interest. The Bank Nifty futures, again, didn't see too much change, but we did see a decline around 9% in open interest. Moving on to the options market, yesterday was a day of trade where we saw the Nifty hover and continue to close at around 24,400, which is why you're seeing so much call and put open interest distribution there. So the expectation is consolidation around range bound movement But moving on to stocks, again, it was a mixed day of trade. We had longs for Coforge, Tata Communication and Syngene International, shorts for Colgate, as well as Dr. Lal Path Labs. And among stocks, we saw unwinding, Granules, Exide and United Spirits. Standing out to a certain extent, even though we didn't see too much with respect to your absolute change in your respective spot prices. But interestingly, poised markets, we must remember that there were plenty counters out there which did move up substantially on the back of earnings. So you do have plenty in terms of that which is continuing to advance, even though the benchmarks don't seem to suggest so. So let's get in an expert here to tell us about the potential opportunities that we in fact do have in the futures and options space. Well, we now have with us Avni Bhatt of GM Financial joining us on the show. Avni, good morning and thanks for taking the time out. What's the first stock on your radar and how are you trading it?
Good morning, Agam, and a very good morning to all the viewers as well. The first stock on my radar is LTIM. So after a breakout of the head and shoulder pattern in the month of August, the stock rallied right up to the highs of around 65.50 to 65.70 levels and has now retraced back to its neckline, which should provide us a good support. For the last 2 days, futures has seen some short covering. There's an interesting observation on the options data for the stock. In spite of a corrective price action below 6,000, the highest OI for October series is pegged at 6,000 straddle, and it's quoting at a premium of around, which is giving us a range, a trading range of 5850 to 6150. 150 is a approximate straddle pricing. So currently the stock is at the lower end of the range, and we expect a good pullback in the stock and very quickly. So this makes it a good case for a pullback. That's why this is unlike normally the trades that I give. We are going for October 6,000 call only because I'm expecting a move very quickly in a day or two and a big move. So we'll buy 6,000 call for the October series in the range of 57 to 59, and target would be 140 on the stock and on the option, and the stop loss can be kept at 30 rupees. And the second stock on radar is Jubilant Food, which is on the short side. So after a decent correction from the highs since last 12 trading sessions, the stock had been started consolidating. But day before yesterday, it gave a breakdown below its consolidation range, and fall-off weakness was seen yesterday as well. So we believe that the minimum downside for this breakdown comes to around 580. And again, that will be a very quick correction without any time correction in between, without any consolidation. So we go for Jubilant Food ATM October 600 put option. It closed at around 10.75 yesterday. We can buy in the range of 10 to 11. The target for this option would be 18 rupees. And the stop loss can be kept at 6 rupees.
Right. And of course, some will argue that there is time decay which plays out, which is particularly high towards the end of the series. But I'd like to remind those who are actually talking about time value that if there are sharp movements, then the price of the premium can go up equally higher. And of course, Avni in this case has already mentioned that she is in fact counting on sharp movements and potentially coming in today and tomorrow over the next couple of days, which is why you'd want to potentially take advantage of that. Well, for everyone who's in the know of parlance, in this case, it's the gamma that she's counting on. But all in all, Avni, thank you so much for joining us and taking us through these two particular opportunities that you have on your radar this morning. We'll continue to keep an eye on that one. Don't forget to write your queries to us on the number that's being flashed for you on your screen, and we'll be sure to take up your F&O query specifically on the 10:30 show that is the F&O show at 10:30 today. So do write to us, and with that, it's back to you all.
Right. It's your birthday, you can do it.
Thanks a lot for that.
Everyone who comes on TV needs to wish him. Agam, have you wished him happy birthday?
I have not. Niraj, a very, very happy birthday to you.
Good.
Okay, thank you so much.
You will be penalized if you don't.
But thanks so much. Thanks so much, Agam. And, so that's the F&O setup. And again, like I said, for viewers, for people who are probably tuning in for the first time, 8:30 to 8:40, We get in Agam with his F&O expertise, and then get in a guest to talk about the derivative setup and some option strategies. So something that is really useful, I would believe. Just before we get to our guests though, I think it's important, Samina, to highlight the key stocks that are there on NDTV Profit's watch list today. So maybe we can go to that and start off with the first few, which have done well, I would reckon. So Godrej Consumer, in an era wherein consumer companies are missing estimates, GCPL met estimates, profit up 13%. UBL is the other one, with some liquor companies off the block, including United Spirits. UBL, I thought, delivered a good set of numbers with volumes rising, so watch out for that. Dixon Tech, massive uptick in revenues and profitability, even if margins came off a wee bit. Reckon the street should reward that. Coromandel was in line with a beat on profit maybe. And Bikaji Foods again, in a space which is seeing some chinks in the armor on consumption, strong growth and steady margins, maybe the street rewards it.
You got a whole bunch of more counters that unfortunately will be on the sell side. IndusInd Bank numbers were a huge disappointment. Asset quality is a big concern. Credit cost has also seen a big spike. The stock will see some selling pressure today. ITC, while some parts of the number looked okay, margins have come in at a 3-year low. Remember, the sector is struggling with rising raw material costs and the fact that urban demand is not picking up as well. And of course, an increase in expenses is what is bad news for ITC. RR Kabel, high metal prices have impacted profitability. The stock will be under pressure today. And CGDS, watch out for this PNGRP notice, which you already took for you, will be counters that you want to track in today's session. Well, those are, of course, our watch list and the stocks that you want to track. There are a whole lot more. But this is, of course, a few that we've identified for you this morning. Well, I think we're pretty much done with most of the FMCG earnings. Most of them have been a disappointment. Urban consumption is struggling. Raw material prices are rising. And that, of course, means the ability to also pass on a price hike is much harder, given that rural is just about at a cusp of recovery while urban demand remains soft. But Mika tracks the sector very closely and is more on that. Mahima, pardon me. First up, you need to wish Niraj happy birthday, and then you tell us what is working for the sector and what hasn't, because the stocks definitely aren't.
Well, Niraj, first of all, a very happy birthday to you on air. I've already wished you in person. So very happy birthday. Always stay blessed. But yeah, moving on, major FMCG companies have come out with their earnings so far now, and there are some key common trends that have been observed throughout these results for FMCG companies. I'll start with top 3 trends that we've observed so far. First of all, demand is under pressure, and demand is under pressure in terms of urban areas. Most of management commentaries coming in saying that the urban consumption is slowing down. Rural recovery continues to outpace urban demand. That's still the story since the past 2 quarters, and demand is also being kind of impacted due to extended monsoons as well. Now, raw material prices inching up is the second key highlight of all of these results. Raw material prices have gone up for most of these companies, which are hurting the margins for all of these FMCG counters. Third thing is price hikes. Because of the raw material prices being escalated, companies are taking price hikes, and most of the managements have commented saying that they might consider further price hikes if raw material prices remain elevated. Now, company-specific points, HUL saw a bip in gross margin by 140 basis points. They expect margins to remain in similar range for the coming quarters, and their underlying volume growth was at 3%, and company might take low single price digit growth going forward if raw material prices remain elevated, is what the management has guided. For Tata Consumers, volumes declined by 4%, and this was on the back of weak urban demand, and they expect overall margins to remain flat or see a slight uptick in FY25 overall. Tea costs for Tata Consumer elevated by 20 to 25 points, and they saw a sharp increase in salt prices as well, which impacted them overall margins. For Nestle, cost of raw materials went up by around 6%. Commodity prices remain elevated, especially for coffee and cocoa, and Nestle's chairman and MD has quoted saying that FMCG firms hit by shrinking middle class is what his thinking is. ITC margins have dropped to lowest in the last 3 years now, and severe cost escalation in leaf tobacco as well as surge in wood prices and the ocean freight will continue to weigh on the paper segment as well. And we've seen almost a 400 basis point dip in ITC margins for its Q2 earnings. Lastly, Godrej Consumer is kind of bucking the trend. They've seen good high single digit volume growth, but prices for them have also, raw material prices for them have also remained escalated in terms of palm oil. But they have not transferred the entire raw material prices to the customers, and yet their margins have remained in line. But what they've said is the margin pressure is likely to remain, likely to continue for the next few quarters as well. So this is the overall trend that is panned out for FMCG companies in Q2.
Thank you for that, Mahima. It's been a tough quarter for the sector. At the start of this year, the hope was a rural recovery would come in and support the sector, which had been struggling, remember, last year too. Well, that has happened. It's urban consumption that's given way, and that's the unfortunate part. Along with that, raw material costs have been on the rise, due to which you are seeing margins getting squeezed, as most of these companies believe in holding on to market share, which cannot really come at a cost of price. Price-sensitive industry as whole, which also means that once you lose the market share, the management of most of them believe that gaining or regaining that market share could become a challenge. Kaustubh Pavaskar, Deputy VP Research of Sher Khan by BNP Paribas, joins in. Kaustubh, good morning. Thanks for joining us. Kaustubh, you've tracked the sector for decades. At the start of the year, we talked about how rural demand would come in and support the sector. While that's happening, urban consumption has given way. Volumes have declined across the board. And I think the joke in the sector is that either you're -1 or you're +5 in terms of revenue, right? That's pretty much been the range. What do you feel? Do you feel the worst is behind the sector and the second half is set to get better?
Good morning and good morning to all my viewers. I guess I spoke on your channel that this quarter the revenue growth would be in single digit, with volume growth expected to be in low to mid single digit, and margins are expected to be lower, and because of the input cost inflation, and on YY basis, PAT growth will be lower compared to what the revenue growth will be. I think this trend would continue in the quarters ahead. We expect margins to remain lower because raw material price inflation is there. However, on the revenue front, we might expect revenue growth to inch up a bit, mainly because of the fact that the companies would be taking price increase in their portfolio, because inflation has gone up substantially. If you take the case of raw tea prices, it has gone almost by 25%. Palm oil prices have gone up in double digits. So company has to take price increase, and it will be across the board. It will, even the loose and unbranded players, they have to take price because they cannot sustain in the market. So in this scenario, when raw material prices goes up, price increases are there in the market, large companies tend to gain share because the pricing premium between the large and small reduces, and that is the time where FMCG companies, branded players, gain market share. So that is what we have been hearing from most of the management, in the conference call. However, in terms of demand, rural is gradually picking up. It is not a significant uptick in demand. Urban is moderating, but there is a sense that even rural demand should see a further pickup, considering the good monsoon. Agriculture output is expected to be good, so that should help rural demand to continue to see a good run. Urban demand is expected to be quite stable in the quarters, right? So in terms of demand, it is rural to pick up. Urban would remain more or less stable or little moderated, and that is how we are expecting revenue growth to be better compared to what it was in H1, slightly driven up by price increases what the companies are planning to take.
Right. Kaustubh, the other concern in this industry is the rising raw material prices. We've seen that for tea, we've seen that for salt. I did talk to Tata Consumer, and they said that they don't really aggressively hike prices or have the ability to pass on the price hike, because this is a price-sensitive industry, and once you lose a customer, bringing them back becomes a challenge. Do you feel like, given that, margins will continue to remain under pressure, stay this way at best, or decline maybe in the second half of the year?
Certainly. So we don't expect, price increases in line with what the commodity inflation is. There will be definitely a gap between the price, the commodity inflation and the price increase what the companies will be taking, because it is going to happen in a gradual manner. And because of that, I believe, the margins would continue to remain under pressure in the quarters ahead. I think once there is a clear stability in the raw material prices, we should expect, raw material pricing stabilizing, and then we should expect gradual improvement. But over the next 2 quarters, that scenario, seems to be a little difficult. We should expect margins to remain lower. We should expect PAT growth to be lower compared to the revenue growth. The revenue growth could be in high single digit to low double digit, but PAT growth would be lower compared to what the revenue growth is, mainly because of the low margins.
Kaustubh, just one question from my end. Good morning, Niraj here. We know that there is slack out there. Where is it that you found a hint of optimism? Because for example, GCPL may not have passed on the entire cost, and therefore maybe there are some margin levers ahead or something else. I saw Bikaji delivering a half decent quarter too. Where is the outlier here this quarter thus far?
See, if you look at GCPL's performance, I think it was much better compared to what the other FMCG companies was, especially at the India business level. They achieved high single-digit volume growth, and that is mainly because of the fact that whatever strategic initiatives they have done in past few quarters in terms of reformulating their HI business, not taking price increases in the soaps, but gradually focusing on gradually increasing it, launching, getting into the high growth categories such as liquid detergents. I think that is helping GCPL, and they have seen an excellent set of volume growth of 7% compared to what the other FMCG companies have done in this quarter. Yet there are a lot of companies yet to come out with the result, but whatever companies results have announced, if we compare to that, GCPL India business performance was good. They also seen a pressure on the margins, but in terms of outlook, they are expecting volume growth to further improve. They are expecting revenue growth to get back into the double-digit growth trajectory, and that is, I think, a good commentary. And the companies who have done a lot of launches, focusing on expanding reach in the rural market, expanding their distribution in the domestic as well as international market, I think these companies are doing much better compared to what the other companies are doing. And I think GCPL, Varun Beverages is classic example of it, where these companies are not doing good only in domestic market, but even their international businesses are doing good. Especially for GCPL, we have seen sharp improvement in the EBITDA margins of the Africa business, and that is expected to continue. Gradually, we should start seeing pickup in the revenue growth of the Africa business. So these are some of the drivers which will help GCPL, to achieve consistent growth in the coming years. So I think they have done well, and we believe that the consistency is going to be there in terms of GCPL in the quarters ahead. Same is the case with Varun Beverages because of the distribution expansion. They are also the international business they have recently acquired are doing extremely well. Integration is happening well. I think even Varun Beverages will do well in the quarters ahead.
GCPL and Varun Beverages is what Kaustubh likes, constructive on both those stocks from the medium term. Global business also for both those companies looking good. A quick check on implied Nifty before we go on and talk about stocks with our guest. Implied Nifty is indicating to a flat start. The last time I checked, which is now, it's down 20 points. 24,400 very likely to be taken out in the early minutes of trade. Kush Bor and Chakri Lokpriya joining with the technical and the fundamental view. Kush, I'll start with you first. What is the strategy on the Nifty? It's been giving up gains, and I know at the early part of last week you were slightly more constructive on Bank Nifty. While that hasn't sold off, the outperformance is not significant there either. Anything on the Nifty, or would you avoid the index for this morning?
So, Samina, before all of that, I don't know, did you hear it's Niraj's birthday today?
Oh, no, not at all.
Did we discuss, did anyone wish him at all? So, Niraj, first up, a very happy birthday.
Thank you.
Hope, this year is better than the last one in all senses for you.
Thank you.
And normally you're the one asking questions. I'll take a couple of minutes, maybe less, to ask you a couple of questions, right? Yeah, first up. what's your secret of getting younger and wiser at the same time every year?
Be with some smart people around.
That's a politically correct answer, but again, being the gentleman you are, we wouldn't expect anything else. Secondly, do you know his wiser side actually pops up on Twitter every now and then, not so much in the studios where he's talking a lot of stocks. So with all that wisdom, Niraj, what is the one thing that drives you, your motto? What's the one thing that really drives Niraj Shah?
That's a good one. I mean, usually it's health. So I don't know what wiser side comes on X or Twitter, to be honest. But yeah, maybe a bit of reading good stuff and then just putting it out.
Fab. And the third one is simpler than the first two. The party, is it a lunch party or the dinner party?
No, we're doing breakfast.
We're doing breakfast. I missed that invite. I missed that memo.
10:30 a.m.
But lovely. Wishing you all the very best for the years to come, Niraj.
Thank you so much.
Lovely. Just to get back to the markets now. See, Samina, you're right. We've seen consolidation. My concern is that, what we've perhaps seen in the Nifty right now is round one of selling, right? There could well be a round two. There isn't anything suggesting that, there may not be. But if I were to take a silver lining out of, what's recently developed in the last couple of days, and for, let's say, a week's perspective, a couple of positives are that the pace of the fall has slowed down. We're seeing a put base, add up at 24,400 and 24,500. So which means that there could be some rebound expected. Also, we're looking at the monthly expiry next week. Hence, and anecdotally, what we've seen is that the trend for the week sort of reverses in the monthly expiry week. So there is possibility that we could see some sort of a rebound on the Nifty. Is that a reason to go out and buy positionally? No, this could very well be a dead cat bounce. So be a little watchful on the Nifty. But as we discussed, on Wednesday, I suppose, is that even if Nifty consolidates, it will give room for stocks to do their own thing. Now, coming to Bank Nifty, you're right that, it hasn't seen a meaningful outperformance, but any outperformance in a market like this is welcome. I still remain constructive. The IndusInd result could perhaps play a spoil sport on the Bank Nifty today. But as long as 50,800, 51,000 is held on the Nifty, you remain long. If you want to create long positions, those are the levels that act as your stop loss. On the way up, you're looking at a 52,200 and a 52,800 as the target.
Chakri, you want to come in? Have you been shopping? Have you been taking advantage of the big sharp decline some of the broader markets of stocks have seen?
Yeah, morning. In terms of, there has been an earnings slowdown, and earnings across board are being cut anywhere between 3 to 7%, depending on the sector. So, the two things that were expected to happen, which is one, an increased order uptake and increased economic activity hasn't materialized. Second, inflation was supposed to have come down, therefore RBI cutting rates. That has not happened. So the net of all this is earnings is slowing down. And therefore, I think, we need to wait. The next catalyst is the RBI's rate cut. If that happens, then I think we will see some revival. But meanwhile, things like IT, which are more export driven, I think IT will do well. Banks have fallen quite a lot. I think some of the PSU banks will also do okay.
Point well noted. Okay. Maybe we'll take the stock ideas in just a moment from now, because we do need to hit a commercial break. So let's get that break out of the way. We'll be right back. A pre-open session, some ideas, some stocks which were in focus yesterday. Try and talk about them as well today. Stay tuned. We'll be right back. Back with India market open right here on NDTV Profit. The pre-open rate's about to kick in. Remember, a bit of a lackluster day yesterday for the broader markets. The global markets aren't quite really shaping up in ship shape, except for if you were Tesla. So that notwithstanding, we're likely to have a sluggish start today. Never mind what happens in the first 1 minute of the pre-open session. A lot of stocks in focus as well. Remember, aside of the results today, the reactions to some of the stocks, any miss, KPIT a case in point yesterday, and we've seen this happening to Polycab and a few others, HUL, and that just shows the mood that the street is in to punish anything that has missed estimates. So in such a point of time, it becomes very difficult to try and identify trades. So Kush, let me first ask you for your trades this morning, and are these, you're going to qualify, are these positional or are these day trades? Matlab sham tak agar profit na bane, get off the trades because stocks are moving very wildly.
Absolutely agree with you on that, Niraj. The only caveat would be, yes, I mean, you could hold these positionally. I'm a bigger fan of the levels, in the sense that, unless those levels are taken out, you stay, into those trades. So on the long side, we've got Max Financial Services. This stock had a good run day before. Yesterday, we saw a very decent follow-up on that in a market like this. I'll take that. Now, on the way up, 1330, 1360 are the levels to look at, and 1260 is where you place your stop loss. Now, I've heard positive commentary on Godrej Consumer today here on the show. However, technically it's not shaping up well. So for me, that's a short. 1240, 1220 are the targets, 1280 is the stop loss. However, given the results, if it does have a positive pop and it opens closer to that stop loss level of 1280, then you don't initiate that trade. But the two trades, on the long side you've got Max Financial, and on the short side you've got Godrej Consumer.
Short side Godrej Consumer, that's the call coming in, despite the fact that the numbers haven't been as disappointing as the rest of the sector. There'll be a lot more other counters that will be technically also seeing some pressure on back of earnings. But I want to take a quick view from Kush as well on ITC. Kush, all the way down from 530 to 470. Now it's a mere 2% up year to date. What do you feel? Do you feel like ITC could see some more pressure today?
In all likelihood, and the reason is that going into close yesterday, the stock closed near the low point of the day, and that is something that could add pressure going forward as well. The volumes were also very close to the monthly average, which suggests that there could be near-term pressure. We've seen pressure in the entire sector. We thought the likes of ITC and Colgate might just buck the trend. Hasn't really been the case. So my suggestion, if anyone's planning a fresh long, you should wait up for some time. A key support zone for this one comes in at about 455. If it does test those levels steady around that, and that's when you buy this, not for a trade, but from a medium-term perspective. At the moment, this pressure could continue for some time.
Chuck, should we just let's go to Puneet, because you've got a few wild moves happening in pre-open trade. Dixon, with its reporting, getting a 10% gap up. I'm hoping that, I'm not hoping, but I think this may settle down in a few minutes, so we'll give it some time. IndusInd Bank, huge disappointment. The stock should be, or was trading about 10% low in pre-open. You also said RR Kabel, bad numbers. Finolex Industries, bad numbers. Puneet is standing by with more on that. Puneet, what is happening? We have a few counters that reported earnings. You want to quickly take our viewers through that? Because Dixon in pre-open is up 10%.
Yeah, definitely. So, the Dixon Tech results were really strong, up 133% in terms of revenue. Margins also really strong, up above 100%, while profits came in above 265%, coming at 412 crores. Now, do note that in this 412 crores, 210 crores is a fair value gain for Dixon Technologies. That's because they have a 6.5% stake in a company called Aditya Vision. Now, do note the last quarter, they sold their security camera business specifically to Aditya Vision and had got that stake in return. And that's one of the key reasons why the profit number is quite high compared to the revenue. If you remove that aspect, the profit growth is about 80 to 90% in this particular quarter. That's still really strong numbers on a very high base of last year. So revenue was 4,900. It's now grown to 11,000 odd crores. When you look at the segmental performance, the mobile division is what's driving the growth in terms of revenue with 235% growth. When you look at the overall margins are down 40 basis points because of the growth of the mobile division. But I think the street is going to look aside from the near-term margins fall, and that's because in the conference call, the management has highlighted that they will be looking to enter into the component side of the business. where they will be increasing their bill of materials for mobile division. So that will aid margins in the next, couple of years. And I think the street will be positive on that aspect. Investec also has a buy call. They have a 15,900 target price. And they mentioned that, the smartphone volume is almost up 6x compared to the last year. Just want to highlight RR Kabel as well, as you rightly said. The results were very poor compared to the same time last year. Revenue is up 12%, but not meeting expectation of Bloomberg, while margins are the ones that have disappointed. 4.7% versus 7.5%. Compared to the same time last year, and the profits fell because of the wire and cable division profitability was impacted due to high volatility in metal prices specifically. That's what the company has highlighted. Also intense competition, and we saw that in Havel's result as well. Intense competition in the wires and cable segment is impacting the profitability in this particular quarter. FMEG was still better, but it's a very low base, just 11% of total revenues, and that's why I think it's going to be negative in trade today. And finally, Finolex. It's a disastrous set of numbers. EBITDA is down 89% compared to the same time last year. Net profit is also down almost 60%, and that's mainly due to a massive inventory loss that the company has taken because of PVC price volatility. Now, we saw that in some competitive numbers that have come out till now, and that's one of the key reasons that they've highlighted, but the proportion is quite higher for someone like Finolex. The pipe EBIT margins are also down by roughly 1200 basis points because of the same reason. So overall, big thumbs up to Dixon, but both these other stocks, RR Cable and Finolex, might be under pressure today in trade.
Certainly looks like that, and this goes with the trend of stocks having very large moves. Now the pre-open rates might be settling in. Just quickly mark IndusInd, quickly mark Dixon. I also want to take a step back to what KPIT Tech might be doing today. So Dixon still about 7 odd percent. IndusInd locked 10% lower. KPIT just a hint of a bounce, so nothing too dramatic here. Okay, now a word on Dixon Chakri. Assuming that it starts off 4 or 5% higher, if not 7% higher, is there a case to invest in that business because of the top line growth that it is showing?
Niraj, first of all, wishing you a very happy birthday.
Thank you.
And, hopefully with your birthday, the markets also turn around and move up. Yes. Dixon, I think very good set of numbers. The electronic components business will add to its margin. And that is in the mobile business. The second, in the electronics business, there's a huge runway. And, even if the company opens up today 5-6%, I would still buy the stock. Because I think, if you look at the next 2-3 years, revenue growth is like, a very strong set of numbers. So you can afford to assign a higher PE, and the margins are holding up. So Dixon is clearly worth looking at current levels.
So Dixon is worth looking at even at the current levels. It's starting off very strong. What is starting off weak is IndusInd. And Harsh joins in right now with, what is it, Harsh? Is it Nuvama or IndusInd? But do we really need Nuvama, or you can replace that brokerage name with any brokerage and the words would be the same?
Not really, Niraj. We're still seeing buy ratings on by a lot of brokerages, very frankly, on an IndusInd, because the target price is, in terms of price to book, is looking attractive in that sense to many brokerages, and that's what analysts on the street are seeming to suggest. But downgrade galore across the board. You're seeing target price downgrades and sharp downgrades. Citi, for example, has downgraded from 2,000 plus to maybe 1,600, 1,600 plus maybe, and just kind of reflective of the kind of mood in terms of the downgrades itself. But what Nuvama has done is they've downgraded their buy stance to a hold, which is a substantial downgrade. What they're suggesting is IndusInd Bank, weakest earnings in the sector so far. Moderating loan growth not looking good. QOQ fall in NII not looking good. MFI slippage is not looking good either. They believe MFI stress is likely to be running high even in Q3. Fee income is running slow, so not aiding numbers at all. They've cut EPS estimates by 20% for FY25, 15% for FY26. Target price at 12.90 now, at 1.3 times FY26 price to book. Stock, of course, taking a tanking in pre-open. But from buy to hold, a big downgrade across the board by Nuvama.
Big downgrade across the board. Retail investors also not too pleased. The stock in pre-open is getting hammered. 10% lower is what we have. Kush, on the charts, 1163 is if we get that open. Would you play a bounce back?
Or would you go short?
Yeah, would you go short?
No, I'd wait this one out. The 200-day moving average support comes in at 1180, 1190 odd level. So there could be a possibility of regaining that level. But given the kind of sentiment that there will be around this stock, you wouldn't want to trade on such a massive reaction. From a technical standpoint, the levels are 1125 to watch for. On the downside, if it deteriorates further, 1125 is where it should take some support and perhaps attempt a rebound. But I would perhaps give it one more day, see how it settles finally, and then consider a buy. Looks very attractive from a risk-reward standpoint, but not in a trend like this.
Not on a trend like this, I think that's the point. But, I just wonder if it's time to separate the men from the boys in the large banking space. So, Chakri, even if you want to go out and buy banks, because private banks might be cheap, would you go out for an IndusInd at the current risk-reward levels, or would you go for relative safety in a sector which is not quite seeing the spurts and maybe stick to an HDFC Bank or an ICICI Bank because those are showing the asset quality delivery that some of the others are failing to show?
Yeah, I'd still stay away from IndusInd Bank. The credit costs are going up, provisions are going up, losses are increasing, loan growth is slowing. All kinds of negatives are happening, and with that kind of environment, it will take the bank quite some time, several quarters to fix itself up. And meanwhile, margins will come down. And multiples-wise, the stock is not an inexpensive stock, and therefore there is no room for error, and therefore I'll stay away.
You'd stay away, avoid IndusInd Bank. That's the word coming in from Chakri on terms of what the reportage has been. Well, we've talked about a whole lot of fundamental stocks, but anything else? Kush, I'm just looking at some of the few early gainers in pre-open trade. And tell me if you think anything looks good for a long trade. Cyient, 5% higher. You've got Bikaji Food, that is up 3%. Nippon and IEX, both those counters expected to see a gap up of 3%. If we do get that, what do you recommend? And also, just a quick one, I know you had a short call on Godrej Consumer. Yeah. In pre-open, the stock is up 3%. So I don't know if you want to go back and review that call of yours.
Oh, no, that's what we discussed. That 1280 was the stop loss. The stock's anyway opening above that mark, so you don't initiate that trade. This trade doesn't even get initiated. On the long side, among the stocks that you mentioned, there was a stock. There is a stock which has been in an uptrend, consolidating now in a market like this, which is Nippon. So that's the one stock that I will be a little constructive on. Even from a near-term perspective, if you see, it was hovering around the 20-day, 50-day moving average, support zones. So on the upside, once that 700 resistance is taken out, you're looking at a 740 and then perhaps 770 also as the target. Could be more of a positional bet because the consolidation phase is still on, has been going on for about 2.5 months. So, but amongst the names that you mentioned, Nippon looks the most constructive. And on the downside, you're looking at a support zone close to the 640 mark.
Well, 2 minutes left. So the key is, Chakri, in a minute, Chakri, from all the results that you've seen thus far, and leave IndusInd Bank out, in the season thus far, which is the one which you will definitely avoid? You've told me IndusInd, fine. Beyond IndusInd, is there something that looks so bad that no matter what, you'll avoid it for the time being?
That's an easy answer. FMCG, I think there's not any kind of firepower anywhere. So across board, I think we just stay away from FMCG, whether it's an HUL or ITC or anything in between.
Stay away from FMCG. Despite this being the defensive bet or has been, it's an avoid coming in. Chakri, what about IT? How do you feel about KPIT? We've seen a little bit of a recovery this morning on the stock, about 1.8% higher. We've seen earnings from the whole bunch of the IT stocks. Anything that stood out for you? The likes of a persistent look very constructive on the outlook.
KPIT is more a company-specific issue. I think manufacturing-related IT spending will take a bit longer. But whereas BFSI has you look at the banks, U.S. banks results, earnings results very strong. So irrespective of who comes to power in the U.S. That is the U.S. presidential election, that's not going to impact the IT sector, giving out orders to the IT sector. So HCLT, persistent, emphasis, all these companies are big on the BFSI sector, and therefore it's quite safe to buy those stocks.
Yeah, and BFS did come back for some of them, for sure. Even Coforge, I thought, kind of showed that. Chakri, that's a nice suggestion. I mean, stay away from manufacturing-led ER&D maybe, but services-led product companies or IT companies could do well. Interesting thoughts there. Okay, what's on our watch list? Very quickly, these stocks, keep them in mind as the market start. GCPL, met estimate. UBL was a good set of numbers. Dixon, the mobile division, red revenue has to be in a green. Bikaji could be in the green as well. And then there are a few others which probably in the red, including IndusInd, maybe RR Kabel, City Gas Distributors. We haven't got a chance to talk about these. We will in a bit as well. But here come the markets this Friday morning. Remember that we will have a start which might be flattish, but individual stocks would remain firmly in focus. It's a flat start, as flat can be. Mid caps and small caps very quickly, and just see what those are doing in trade. Mid cap index again very flattish. Small caps 0.33%, so a bit of a respite there, but it's an absolutely flat day. No movements this Friday. Not quite seeing a Tesla here. Maybe on the downside in IndusInd Bank. Let's get the heat map, and you will definitely see IndusInd here. 10% lower. Nothing different. It's 10% slam dunk for IndusInd today. NTPC, a reaction to its numbers. Mahindra & Mahindra, Hero MotoCorp, Maruti, Bajaj Auto, Eicher, showing that auto is in the weak lane as well, and that's putting pressure along with Reliance Industries. But the big culprit is IndusInd Bank. What is thwarting that? Axis Bank? What is IndusInd's loss? Is it some other bank's gain? And therefore, maybe the Axis and the Kotaks of the world are doing okay. ITC is reacting positively to these numbers. And I thought for a moment that the street might reward the revenue growth numbers a lot more than it may punish the margin miss. ITC is getting rewarded for the revenue growth. Companies are not able to show growth. ITC is doing that. HCL Tech, Cipla, Asian Paints are amongst the others. But Samina, suffice to say, the morning still belongs to the losers on the large cap side. And while IndusInd was an easy one to guess, the weakness in auto and NTPC reaction also stand out.
You know, you're right about ITC, Niraj, because across the industry, the highest revenue growth we've seen for any company outside ITC has been 5%. So this one is a clear outlier, and the reason you're also seeing an impact on margins is because you've seen a big jump in other expenses, which is one-off. So, and also let's not forget that the counter was down 2% yesterday. It's only up 2% year to date. So it's a largely an underperformance compared to most of its peers. I know Gautam Shah calls this the Rahul Dravid, and it's acting like one this morning. 2% high in ITC on back of numbers that are not looking as bad in terms of the top line growth. Well, along with that, the broader markets are fortunately not doing too much, so we're going to take heart from the fact that we're not selling off this morning. I know Niraj is disappointed that there's not lots of green on his birthday, but I think the good thing is that there's not too much red today, right? The Nifty is flat, mid and small are trading flat. Bank Nifty did pull out some outperformance yesterday. In today's day of trade, Bank Nifty is giving up gains. So you're seeing pressure at Bank Nifty. 51,400 is what we have on Bank Nifty. The breadth of the market also not looking too bad or too good at this stage of time. But early minutes, early ticks. Niraj has highlighted IndusInd Bank, so we'll skip that, but let's move on to the broader market earnings. There were a whole host of them that came through between yesterday close and this morning. IndusInd is your top loser, down 10%. That's already been highlighted. Dixon Tech, now look at that. Pre-open was indicating to a 10% gap up on the stock. What has actually happened is the stock has opened up as flat as it can. I pointed out Finolex cables for you. The numbers were a huge disappointment. Their margins have dropped to 1%. From a double-digit 12%, and the stock is getting hammered on back of that. They are getting punished. It may be a one-off, but for now, it's not looking good for Finolex Cables. The stock is down 7%. RR Kabel also reported numbers. I will talk about, if I can get that one up while we're talking about similar sort of companies in terms of reportage as well. But I'd imagine RR Kabel also should see some pressure in trade this morning. Nippon on the upside reported RR Kabel, there you go, down 5% in trade. So RR Kabel, Dixon and Finolex are the three stocks on our radar. Dixon, I'm assuming, will see some buying emerging as the day goes along. Nippon Life reported very solid numbers. The stock is up 8%. Radiko and Bikaji Foods were the standout in terms of consumption reporting. Both counters up 8%, Bikaji up 4% is what we have. So good earnings from those two are getting rewarded. IEX did a good quarter. Numbers were good, better than street expectation. The stock is higher. No runaway rally just yet. Aarti Drugs numbers were weak. The stock is down 2%. And Cyan reported numbers as well that beat street expectations, on back of which the counter is up 2.5%. So all in all, No wild swings so far, apart from, I guess, IndusInd Bank. And you've got City Gas distributors that are seeing a little bit of pressure. MGL down about 2% on the PNG RB issue notice. But Niraj, I think I'm surprised with Dixon. At least closer to a 10%, if not 10%, but this is as flat can get.
Yeah, maybe the valuations. It's great earnings have hit the wall of valuations when it comes to Dixon, I reckon. IndusInd is down 10, but Dixon is the stock. I mean, IndusInd, I think we'll talk about it once it opens up. Some other stocks, steel stocks have seen a downside catalyst watch. Colgate has seen some downgrades today, and those should come up on your screen as well. So Tata Steel and Colgate is down 3.5. Tata Steel and SAIL have seen a downtick from Citi, a negative catalyst watch. Let's see if those two look weakish. So we've taken the fundamental check on Dixon. A quick technical check, Kush, on Dixon Tech, because it's not quite starting off well. In fact, a bit lower in trade.
Well, this could continue. We've seen a massive, in relative terms, a massive sell-off from the highs of the day, from where it started. And, we've seen the stock consolidate for the last 8-10 odd sessions. So this could continue for some time if it's not reacted to, these kind of numbers in a very positive way. I think this consolidation could continue. You have support near the, 14,800 mark where the 20-day moving average resides. But for any kind of a significant up move, I'm actually looking at 15,600 to be crossed, preferably on a closing basis. That's where you will see the big jump come in. So this consolidation could continue, and as you rightly said, perhaps valuation, perhaps selling pressure, playing its part. But even with this constructive setup, I don't think there'll be a too big a run up until at least 15,600 is taken out. Also, a quick word: Godrej CP had a very good start. Even now, the optics would suggest 2.5% uptick. But if you see from the high point of the day, 1330 where it made, it's already seeing a bit of a sell-off. This could continue for some time, not initiating that short trade just yet, but just putting it on the radar that, despite good numbers, some of these stocks are still under a bit of a pressure and could continue to remain so.
What is stock of the morning is PNB Housing Finance, 10% higher on the counter. So this, along with Radico Khaitan, Nippon and ITC, look at that move, 487 on ITC. Kush, I'll come back to you on this one, and I'm putting you in a spot I know here, but you were negative ITC when I spoke to you this morning. At 487, have you changed your mind?
No, not at all. It's just that, some of these names that have actually seen a bit of a correction could see a bit of a rebound as well, right? And we did speak about the dead cat bounce on Nifty. That applies to stocks as well. So yes, there is this bounce. Not sure if it's sustainable. Perhaps if 500 is taken out, you might see that. But a round of profit booking could come in. Maybe not today, maybe, in the coming week. But again, there could be some pressure on these stocks. So for me, 450, 465, those zones remain the buy zone for ITC.
It could be a dead cat bounce, but if you picked up the stock this morning, you'd be making some money. So you could ride the rally out. For now, ITC contributing well to the Nifty this morning. PNB Housing, anything on this one? Chakri, do you track PNB Housing? What's up here? 9% higher. It's one of your top Nifty 500 gainers.
Yeah, in fact, PNB housing companies, I think, will eventually benefit, in the coming quarter or so. As interest rates come down, most of the mortgages in India are on a floating loan basis. The company's valuation is okay. It's probably about 1.5 times book. And if you look, and therefore in an accelerating environment, and in an environment in the banking space where generally it's slowing down, housing is held up. The valuations on their side. The PNB Housing, LIC Housing has its own share of problems, but that also looks okay.
When I read the brokerage views on United Spirits, were all constructive about the company despite the fact that the quarter was wobbly. Now, Radico Khaitan, and it's up 2% by the way, because the belief is that the growth in volumes for the entire liquor space is going to be solid. And Kush, Chakri, what are your thoughts here? Radico Khaitan, United Spirits, Piccadilly Agro, Tilaknagar Industries, the new listing, Allied Distilleries. Any thoughts on some of these?
In the Radico Khaitan, numbers were good. Numbers were held up. The raw material costs are coming down a little bit. They've had some kind of relief in some of the regulations in some of the states. So that will help earnings in the next quarter as well. So if you add up all and plus festive season, some amount of volumes support is there. If you add up all this together, I think valuation looks okay for Radico Khaitan.
Okay, fair call. So that's the view on the liquor space. Thanks so much, Chakri. We'll leave it at that. Really appreciate your time this morning. Thank you so much for that. Kush, first 9 minutes of trade, what has stood out for you?
ICICI Prudential. This was a BTST call that we had discussed yesterday. Bit of a gap up opening, 0.5% or so. So, this is one stock that could continue on the upside. You're looking at targets of 800 and higher. And on the downside, support comes in at 755. So that's one stock that you can keep on your radar.
You're not going long. You are telling people to keep it on the radar, right?
Oh, no, I am suggesting a long. We did discuss this as a long position for BTST yesterday. Pretty much about the same level. So you could still consider this as a long position.
Okay, fair call. Thanks so much for that. Kush, really appreciate you taking the time out and being with us today.
Pleasure.
All right, that's the view on some of the specific stocks. Now, what has stood out is in the earnings and otherwise is some macro headwinds on the anvil or already there. IMF retained the FY26 growth forecast is fine, but we've heard Nomura and a few others speaking about growth pangs. Goldman Sachs expect growth and profit slowdown as well. Now, before we get in Manish Dangi, who has a keen eye out for this, let me get in my colleague Harsh, who joins in with some specific details around this. Harsh, good morning.
Good morning, Niraj. Very interesting commentary coming through post Q2 earnings. But let's look at the macros first. 7.2% is what RBI expects India's growth at. That's unchanged both in August as well as October. That's a possible positive. But let's pull up what other views seem to be saying. Well, FY25 IMF forecast is 7%, stand corrected there, 6.5% for FY26. What they're suggesting is pent-up demand likely to get exhausted. So no doubt about that one. With regard to what Goldman Sachs seems to be suggesting, FY25, they have a view of 6.5% GDP, which is 40 basis points lower than consensus. So they are expecting a lower number, and they believe that even from a market perspective, they've lowered their weightage on India. They're expecting growth and profit slowdown to come through, and they're seeing some moderation in high-frequency indicators. This is, of course, basis their recent report. They're expecting a worsening in earnings sentiment, which also seems to be creeping in, especially in broader markets. They're seeing accelerated pace of EPS cuts going in to November as well. Of course, what lenders have been suggesting, and this is all commentary coming through, H1 has been slow is what lenders suggest. Basis elections, heat wave, monsoon, all of it creating a drag. Microfinance is facing, of course, clear pain. You're seeing the reaction on IndusInd today morning as well. They're also saying that personal loans, especially with regard to credit cards, unsecured loans, as well as rural, is seeing a lot of pain. So there's pain there as well. Slightly soft Q2 both for Bajaj Auto as well as TVS, indicating some bit of slowdown. Festive demand also is yet to pick up, is what Bajaj Auto said. They're also expecting festive growth to be slower than what was earlier anticipated. That's all of the commentary coming through from the auto pack. FMCG, that's the other one, key on consumption. Challenging environment with muted demand is what Nestle has suggested. Commodity cost pressures continue. We'll also talk about Tata Consumer. That's what they're suggesting. Cautious on recovery with regard to volumes. Similar commentary coming from HUL. Urban growth is slowing. Rural growth gradually recovering. So not looking good. Last off, just with regard to our rate cuts on the corner, that's something that you could keep on your radar with regard to recovery. Rate cuts on the corner. H2 likely to see a pickup on the back of heat wave and a good monsoon. In fact, and all of that is now behind us, and festive as well as demand as well as recovery. Will that happen in H2? All of that on our radar, of course.
Let's ask those. Harsh, thanks for that. Let's ask those questions to Manish Dangi, CEO and founder of Mosaic Asset Management. Manish, good having you. Thanks for joining in. Just trying to understand from where you are perched and when you're looking at the landscape, are there growth pangs? Is this a cyclical downturn that we are entering in, and could it last for longer?
Longer questions actually basis, how long do you expect? Typically, cyclical slowdowns tend to last for about 12 to 17, 18 months. But the first question, of course, is there is certainly no case of structural slowdown in India. There is little doubt now that India is slowing down pretty rapidly in the last couple of months. So it appears to be a cyclical slowdown. All signals, both in consumption as well as industrial slowdown, is underway right now. We saw that happen in Europe in 2022. Part of it was structural. A lot of it was cyclical. China, it happened in last 17, 18 months. India seems to be the next big economy entering a cyclical slowdown.
Manish, just a follow-up on Niraj's question. What and how did this cyclical slowdown suddenly happen? And do you feel like a monetary policy action could help it? I ask you this because that's all we've really talked about in the last few months. But everything looked well till a quarter ago, I thought.
I mean, economies tend to have these 18, 20 months of boom-bust cycles, industrial economies at least. Why do they happen? It's the way nature of things are, that, things go up, come down, go up, come down. So the only truth in economies and markets is that, they are cyclical. Antidote or a solution to that is, of course, policy easing, because cyclical slowdown would not last for very long if an appropriate policy response come in, either by way of fiscal stimulus or monetary policy cuts or regulatory easing. So all of these are, necessary conditions for us to tame or to ensure that the cyclical slowdown is not too deep. Now, would that happen or not? Of course, we should discuss. There are right now problems of signaling as far as RBI is concerned. On one hand, RBI is trying to signal NBFCs to tame down because, RBI seems to be worried of household leverage here and excessive growth in NBFCs. So simultaneously, you really can't ease rates. So which is why, they have to sequence it, They have to ensure that the NBFCs and many personal loan segments slow down, and only then, they'll be able to unleash monetary policy easing.
Manish, the telling part of all commentary that we've heard thus far from the corporate sector on the consumption side is that rural may be picking up a little bit, but urban is definitely slowing down. Now, is this a base effect? Because post-COVID, everybody said, oh, let's spend on experiences, etc., so on and so forth. So people have spent for 3 years on a trot. Is there satiety plus base effect coming into play here? And will this change if indeed the growth doesn't falter too badly?
Yes, you're right that all economies have gone through this small bust is essentially because COVID response, revenge shopping of sorts, did happen for a while. India actually sustained it longer than, many other large economies outside of US, of course, which continues to roll, which basically means that, Indian conditions were relatively better. But then as it has happened in all other parts of the world, we are also slowing very rapidly. So basically, yes, it's a post-COVID surge and a slowdown. But had COVID not been there, something else would have been there. They would have been slowed down first in 1920 and then rise and rise. So in a sense, it has happened, right? There's every 3-4 years, you have these small cycles slow down. This time, unlike the previous slowdowns, macro seems decent. You have low inflation, current account deficit is low. There's a space in terms of monetary policy. So, we can deal with it. It's just that it's a sequencing problem RBI is grappling with them, which is why, even though India requires, paradoxically, more rate cuts than US, and yet we don't get it because RBI is trying to signal to the NBFCs and the financial sector to slow down first. And so therefore, they don't want to confuse markets right now, which is why we're sort of having a little bit of a delay in policy response. The collateral damage of that, of course, is that the slowdown can persist for longer and get little deeper before it gets better.
And then the argument about too little, too late will begin, but we'll wait till that happens. I want to talk about bottom line in that sense, right? Raw material prices have been a big concern for consumption names. Actually, anything that's consumer facing has had a struggle. Commodity prices are on an uptick. Imported inflation hence becomes a problem for India. Even local inflation now is a problem with what we've seen in terms of agricultural output. How is this inflation piece going to fit in the puzzle? Because if you have slowdown on one hand and inflation on the other, it's a much tighter row for the RBI to walk than it is for a Federal Reserve.
No, I have a little bit of contra view here. I don't think inflation is a problem in India. Core inflation for whole of 2024 has been near to 3%. So demand is a problem in India. Inflation is not. And therefore, purely from a growth inflation dynamic, the pace, you can sort of have a reasonable amount of monetary easing. So again, I don't think that, we'll have too little of monetary easing. I think, and I've argued this in the past, that, India in this cycle will end up having pretty substantial easing to the extent that, bonds would go to the levels that we haven't seen for the last many, many years, at 5 handle or so. So again, India is sort of witnessing growth slowdown, both urban actually more deeply. Rural has been a listless part of economy in any case, and did not grow as much as we would have anticipated, even though the food production has been decent. So it's an urban consumption slowing which is driving the Indian economy down. Core inflation is pretty low, and therefore the space for monetary easing, purely from the point of view of growth inflation mix, is pretty substantial right now.
I'm going to make a quick comparison to what's happening in China, only because we've been talking about it so much. So I think we should end the week also talking about it. How has global economic uncertainty, particularly the slowdown in China, in your opinion, impacted investment flows or trade inflows into India? And I'm not going to talk about the money that comes in, or non-sticky money that comes into equity markets, but more from a structural angle.
So the FDI flows in India, for the last couple of years have been listless, frankly. Barring the first year of COVID, since then I've made this argument on your channel also many times that FDI is surprisingly a missing piece. So there again, no incremental surprises. It's simply FDI, FII are very sluggish in India over the last couple of years. What is surprising, actually, I'll tell you, is that, after all the halla of, that CapEx recovery is underway, what we now know as a matter of fact that it has not happened, despite very high capacity utilization, very, very high margins in corporate India. Outside of the top 500 corporate, the CapEx in a reasonable manner that should have happened by now hasn't kick-started yet. Which is sort of, so the story in India right now is not that the consumption is slowing down. That is something that we could have expected that would happen, as it happened in many other parts of the world. What is surprising is that the industrial capex in India is not accelerated, despite all the enabling conditions being in place for the last couple of years, which is the only sort of thing that, equity markets or, even policymakers should be worried of as to why did it not happen. The proximity to China is only to the extent that China is glutted with sort of manufacturing good. And so to some extent, it is a deflationary force for the entire world, also of India. And also whoever is, let's say, is competing with China will have this dampening force coming from China and, potentially would not crank up more capacities, So that is the China connection that India has. Which is the negative one. Positive one, of course, is that, we actually import large amount of goods from China, and, if they get cheaper, it's good for us.
You're such an expert on the economy, just like you're in equities. We'd love to. I personally would love to chat with you longer on the macros, but hopefully we'll do that the next time we catch up. In the meantime, we are in the thick of the earnings season. We had reporting that came in from CSB Bank, where we have the management now, MD and CEO at CSB Bank, joining in to talk about the quarter that's gone by and the outlook ahead as well. Pralay Mondal joins us this morning. Hi Pralay, good morning. Thanks for joining in. I know my team is extremely excited to hear your view on the outlook of the sector, how the quarter has been. So I'm going to start and take this head on from picking up answers or responses that you gave us last time around. First up, how has the quarter been? And you did tell us, I believe, in the last quarter that margins are coming to a bottom. Is the bottom here?
Good morning, Samina and your viewers. I think very relevant question that, what we spoke in the last quarter, we have sustained that. I think on a quarter-on-quarter basis, we have really done well. Whether you look at the growth on the deposit side, we have grown by 25%. The asset book has grown by around 20%. The margins have sustained at similar kind of levels as last quarter, and sort of I think it is bottoming out. Of course, the cost of deposits is elevated for the system, so is with us. And from a GNP and NPA credit card perspective, we have been a little bit flat quarter on quarter. Though on the credit cost, we have reduced slightly. So outlook ahead, I think we look ahead. I think from Q1 to Q2, we have done better. On YOY basis, also we are doing okay. Q3, we are planning a lot of executions, and hence we are looking forward to even more exciting quarter in Q3.
Pralay, the cost of funds have also increased by 20 bips Q on Q. What factors have contributed to this increase in credit cost, and how do you plan to manage this? Because if you do believe that margins are bottoming out, it'd be nice to know what and how will you manage the rising cost of funds in an environment where rates are rising?
See, I think what's happening for various reasons. I mean, liquidity was an issue. Now, in the last cycle, what RBI governor and the MPC did was they changed the outlook towards neutral. So, from that perspective, I think liquidity will be there in the system for a while. At the same time, one has to juggle around with the LCR, with the CD ratio, with NSFR, CASA ratio, so many other things in a time when there is enough demand of deposits. So from that perspective, I don't think that deposit rates are coming down in a hurry. So from that perspective, banks have to manage it pretty well. So what we are doing is we are managing between CDs, deposits, CASA, and borrowings. And of course, refinance, which comes at a slightly lesser cost. And overall, while there has been a marginal increase on the cost of deposits, yields have also slightly increased. So to that extent, we have been able to manage our NIM almost at the similar level as last quarter. Going ahead, I think increase in deposit costs will be marginal because the last lingering part of the repricing on the deposits is going on, which should be over in another quarter or so. So I don't see too much of pressure on NIM anymore, maybe another 3, 4, 5 basis points here and there. But beyond that, I don't see any more pressure on the NIM for us.
So, there's been a standout with your earnings, right? There's no concerns so far, at least on your asset quality, but we are seeing across the industry, it's not as simple or straightforward. Your gross NPAs have remained steady. Net NPA also has seen a marginal increase. Any sort of thoughts on what is going on? Do you think you will continue to maintain an improvement on asset quality going ahead? Or do you feel like a couple of quarters out or even in the second half of this year, asset quality does become a concern for the sector and for you as well?
I think sector is going through a little bit of a, revaluation on the entire asset quality, primarily because of on the retail side, microfinance, on the unsecured side, there is a little bit of a pressure which is building on. For us, GNPA has remained the same, and NPA is hardly 1 basis points up. But the good part is slippages has come down significantly from last quarter, and I think we continue to do that. Credit cost has also come down reasonably well from last quarter. So I think we are sort of peaking out on the NPA as well. I don't see too much of an elevation of NPA from here onwards for us at this point of time. And credit cost, I mean, when we are around 15 basis points, it's difficult to say 2 basis points up or 2 basis points down, but I don't see us going beyond 20 basis points for the full year. So to that extent, I think we are pretty clear that credit cost is not a concern for us at this point of time. But yes, for the system, especially players on the microfinance side, on the unsecured side, retail is also seeing some kind of a leverage. Fortunately for us, we sort of slowed down on certain segments like microfinance, personal loans, unsecured side quite a bit. So to that extent, that part of the portfolio is picking out in terms of stress. But one-off cases here and there can happen, so we cannot exactly predict what is going to happen. But I think we are reasonably okay on the credit card side.
Yes, taking a little bit of a step back from lending or increasing lending in the microfinance space has helped. And we've also seen that part of the economy may be going through a little bit of a struggle going ahead as well. Pralay, how have you utilized your contingent provisions? Have you to begin with? And if yes, do you have comfortable buffer, at least for the near to medium term?
Samina, what we did is during the COVID times, we created a provision of around 105 crores. So we have not touched it. We have converted into contingency provision and we have retained that. Also, above regulatory guidelines, we have created extra provisions. So overall, we have around 183 crores of additional provision, which is a fairly good buffer. And this will continue to grow because our policies are slightly more conservative than what the regulatory prescriptions are. So to that extent, we are pretty comfortable and we don't aim to touch this contingency provision which we have created as a buffer, because who knows, in a cyclicality we need to be a little more conservative, and we believe in conservative mindset. Also, what we did is in the credit cost, we added, unlike last year, we added the standard provisions into the credit cost. So it is not a like-to-like comparison. It is a little more conservative this year. In spite of the fact we have on a quarter-on-quarter basis, we have reduced our credit cost. So overall, we are looking at more conservative accounting going ahead, because that's, I think, the prudent banking in a cycle where one is not sure what's happening in some of the sectors. So we are pretty comfortable on that front.
Just one quick question on the gold loan space, because that's been doing well for you, but we know that the RBI has been sending out feelers and warnings about the processes meeting standards. In your case, any worries there? Are you concerned? Are you going back and sort of fixing the processes that you currently have, or are you confident you'll meet those standard requirements? And of course, the growth will continue in that space.
Yeah, I think growth is happening because of two reasons. One is, for us also, the growth on the tonnage side, which is the real metal, has grown by around 10%, while the growth on the book is around 28-30%. The difference, of course, is because of the gold prices internationally is pretty high, and that is also leading to the high price in India. I don't see, because of the Fed easing cycle and things like that, I don't see too much of a risk on the gold price right now. Having said that, being a conservative banker, we would like to always have a sensitive analysis on what happens if kind of a scenario on gold prices. And we are pretty comfortable because LTV is pretty close to 70%, near around that. So we are pretty comfortable on that front. On those 4 or 5 points which RBI, the circular on 30th September, fortunately, because we have a large portfolio on gold, we have been proactive on all of this. So almost point by point, when the circular came out, we reviewed and saw that we have sort of meet most of the boxes, actually all the boxes. Having said that, it's being a very touch and feel kind of business. For example, we never did anything other than physical touch and feel kind of a business. We never had those fintech partnerships on the gold loan side and those kind of. We never believed that that's the right model for us. So to that extent, we are pretty much comfortable with most of the processes or policies which has been prescribed. Having said that, being a very touch and feel, we are increasing our audit processes. We are increasing our documentation rigors there, because touch and feel, you never know where somebody is doing what. So we need to constantly monitor that very carefully. But on a big picture, we are pretty comfortable with most of the points which has come out, because we had worked up most of them proactively.
You are growing at a very healthy pace, solid growth, and we'd have loved to talk to you longer to understand the key growth levers in the second half of the year. But congratulations and good luck, Pralay. We'll hopefully catch you next quarter.
Thank you, Samina. Thank you. Have a good day.
Thank you very much. Thank you. Well, that was CSB Bank. It's been an outlier with regard to its earnings. Asset quality concerns don't exist in this bank. Gold loan is picking up, and they very clearly said that they've voluntarily taken a step back from microfinance, which seems to be a little bit of a concern area for the banking sector. But over from one good company to another good one, another great one actually. Dixon, what a quarter.
Yeah, seriously, what a quarter. And Saurabh Gupta, CFO of the company, Johnson, right now to talk about the quarter and the outlook. Saurabh, good having you. Thanks for joining in.
Hi, good morning. Good morning, both. Good morning.
And how do you characterize the quarter, Saurabh? Because I would look at it as a glass slightly more than half full, because the revenue numbers were rock solid. What went behind the quarter?
Yeah, so clearly, I think so. We think it's a good set of numbers. Clearly, what we had planned for this quarter, we have slightly bettered or overachieved those numbers against the budgets that we had made for this quarter. So clearly, mobile is doing very well. We have been able to have a large set of customers on the Android ecosystem. Our acquisition of iSmartU, which happened during mid of August, has also been playing out. We're looking for some more customer additions in this category. We are looking to deepening the level of manufacturing by getting into displays, precision components, and mechanicals. And then the IT hardware by next financial year should should start delivering. We already have tied up with some of the large global brands in IT hardware. Yeah, so overall, we're sitting on a good opportunity, and all of that has come by still maintaining a very strong balance sheet. So my sense is, we are sitting on a good opportunity right now, and things look very, very exciting and positive right now.
So what doesn't surprise is this ramp up in mobile volumes, because you've spoken about how the focus is so strong there, but the ramp up was strong and very sharp is the term that some analysts have used. Is this the nature of things to come, or have you kind of preponed some of that production to take advantage of festive demand that your clients might have wanted? Give us a fill on that.
No, I think so. It has panned out that's exactly what we had thought. In fact, it will only get better from here, because one of the customer additions we start manufacturing from November onwards, and we are looking for even a large brand, which would hopefully happen in next couple of quarters. So by next financial year, yes, the volumes can be potentially even better, because some of the brands that we just started in this financial year would also get ramped up and would also have full year numbers for next year. Yeah, and then our piece on the backward integration, where we have tied up with HKC, which is the largest global company on the open cell and display manufacturing. That number should start coming in from the next half of the financial year, H2 of the financial year. And that would really add a lot of competitive strength more to our business, add to our margins, because all this backward integration play, whether it's display and then our future strategy on precision components, mechanicals, die cuts, would significantly boost our margins in mobile, which is the largest play. So one, you will have the revenue growing, and then on top of it, the margin expansion can potentially happen in that category.
Okay, that's first. Second, I'm sticking to the top line first, and then I'll go to the operational metrics. When washing machine volumes, the industry trend is very soft, but you've seen continued strength there. Similarly for refrigerators, right? You've had higher capacity utilization, announcement of further capacities. What's going behind this? More customer additions, or is there something else sort of working for you?
Yeah, so washing machine, as far as the two categories are concerned, semi-automatic, we have already taken a large market share. We continue to add customers, but that number has now gone to a single-digit kind of a growth in terms of volumes. Of course, we keep doing better in terms of margins because of the operating leverage, because of a lot of work that we are doing on value engineering, on our cost optimization. But the fully automatic, which was slightly took us more time to stabilize, there the volume growth has been slightly better. So we have seen a 50% growth in the volumes in this quarter against last year. And refrigerators, to our surprise, we were able to ramp up and clock a volumes of almost 80,000-90,000 within a very short period of time. Clearly, I think so, refrigerators, we were able to acquire large marquee clients within a short time. And there now the visibility is to actually expand into other categories of frost freeze, side by side, 100 liters. And we further expand our capacities in direct cool. So that business also is looking quite promising. Yeah, and then the IT hardware next year should really be the next trigger of a growth after mobiles.
In fact, yeah. So talk to us a bit about that as well, because almost all notes seem to suggest that the components piece will improve the profitability. You've apparently sounded confident that the first phase of the HKC JV display facility will also get absorbed, and all of those factors. So talk to us a bit about this.
About what?
The components piece, right? Right.
Component, So component, if you look at the total value addition in mobiles is presently 16-17%. Now we are targeting to add displays, which will add another 8 to 10% to the value addition. And the precision components, mechanicals, where we are actively pursuing some partnerships, and also the die cuts should add another 7-8%. So the idea is to go to around 34-35% in the next couple of years. So if you look at any mobile phone, almost 50% of the bill of material is semiconductors. So we are targeting the non-semiconductor portion, which is the balance 45-50%. And we want to have a large play in that non-semiconductor portion. So that would really add to our strength, the moat in the business. It will expand our margins, and it will really enhance our stickiness with the consumers as well.
Could this, I mean, aside of the valuations being, I'm not asking you to comment on the stock, Saurabh, but I'm using that as a crutch to ask my final question. That the reaction to the very good set of numbers largely has been slightly negative right now. Could the margins be the reason why that has happened? And you've been speaking about the fact that because as you focus a lot more on mobiles, maybe the margins come off a little bit, but the top line growth continues. So tell us a bit about it, because in this interview, twice you've told me that you're looking at better margins. We've seen a 30 basis point slide in margins YOY. What's the outlook for the second half or for the year at large?
Yeah, so absolutely, I would say that the margins, the margins, if you look at in its absolute, I think so. The margins will be around 3.7, 3.8% as compared to maybe slightly higher than what we had thought. But my sense is another 12, 15 months, once the backward integration play starts to reflect in the numbers of mobiles, then you will see a significant margin expansion. It can potentially expand by almost 100 bips from the current level, so slightly higher than that. So my sense is another 2 years it will take us to completely ramp up and stabilize the backward integration play. So FY27 we'll see a significant margin expansion, but you will start seeing that margin expansion from in the next half of in H2 of the next financial year. So my sense is, one, apart from the margins, one should look at the absolute growth in EBITDA and profitability. And all of that is coming not at the expense of compromising on the balance sheet, free cash flow, or the ROCs. So ROCs continue to expand. So in the last 1 year, we've expanded the ROCs from 30% to 38.9%. And we feel that given the asset turns in both mobile and IT hardware business, and also strong margins in backward integration, the ROC profile can continue to expand. So that is
continue to expand. Where do you want to take it to, Saurabh? Or where do you believe it could go to? Let's say 2 years, 3 years out.
Yeah, I am very confident that in next 12, 15 months, it can be as anywhere in the range of 42 to 44%. So it should further expand, because even IT hardware is a very high asset turn business. And you really need to manage your working capital, which we have been doing well on that thing so far.
Saurabh, I'm completely out of time on the show, but I have to ask you this one question, 60-second answer. You are already the largest market share in a ton of categories. How do you grow on this base? Do you add more consumers or more product lines? 60-second answer, Saurabh.
So more product lines, more categories within that same category. Exports, we think we are now becoming globally competitive in certain categories of exports. So exports will play a major role. And we'll continue to add more categories around our core of electronics, or more product categories. So the balance sheet is strong. Wherever there is a possibility that we can generate operating leverage, create a large scale, and it's linked to electronics, we'll definitely look at it very seriously.
Well, all the best for these plans and more, Saurabh. Good quarter. Thanks so much. So congrats on that. Thanks so much for joining us, to you and yours. Very happy festive season.
Thank you, and happy Diwali to you and everybody. Thank you.
Thank you so much. And with that, it's a wrap on India Markets Open. Up next is Talking Point. Thanks for tuning in to Talking Point. I'm your host, Niraj Shah. Split into two Talking Point today. We have a corporate conversation with Laurus Labs coming in about 10:12. But before that, it's just an important day and an important juncture to get in Rajesh Bhatia, CIO of ITI Asset Management Company, because he thinks very deeply about some of these aspects which might be hurting portfolios. And Rajesh, thanks for taking the time out and joining us today. At the onset, festive greetings to you and your team and family. But tell us, I mean, this festive season is turning out to be anything but festive, particularly for the broader end of the spectrum, both in results and in stock price performance. How do you view the landscape?
So Niraj, thank you for your wishes and wish you and your viewers a very happy Diwali. I think as you pointed out, the highlight of what's going on is the really poor results at the peak of the market. Right. So I've never seen so much breadth of poor results as we are seeing this time. The second highlight is really the incessant selling by FIs. I thought earlier that the FIs were selling because they wanted to move from an expensive India to a cheap China. Then we actually thought that maybe they are concerned about the escalation in the Middle East. But really, I think that wasn't really the reason why FIs are selling as much as they are. I think the main reason why FIs are selling is because interest rates in America have gone up. There is a trade that is taking place where people believe that, market participants believe that there is going to be inflation coming back. That if Trump, or even if Trump doesn't get elected, particularly if Trump gets elected, the fiscal is going to be unleashed. There's going to be large issuances of debt, and that is going to lead to long-term interest rates going up. Clearly, if interest rates go up, and God forbid if inflation catches up, then my sense is that that is bad for equities. So that is the conviction with which why FIs have been selling clearly what is an expensive Indian market as a result of this trade taking place. You can see that trade taking place in other parts of asset markets as well. Gold is at a new high. There is good demand for crypto assets. Dollar is stronger, etc. So I think the highlights are poor results at the peak of the market and the incessant selling caused by the rising long-term yields in America.
That's interesting that you mentioned that, Rajesh, because one thought that with a 50 basis points cut and possibly penciling in more, that the trade was going to be that money will move from US to EMs. You are saying quite the reverse is likely to happen over the next 6 months. So if that were to be the case, how big a negative would it be for EMs like India, particularly because it was not that FIs were overweight India. While they are pulling out in October, it was not that they pumped in a lot of money before October any which ways.
Yeah, I mean, and the conviction with which they are selling, right? I mean, even the selling was 5,000 crores. And, that's what made us wonder, why are they selling so much with such conviction? Yes, I mean, I think the trade earlier when the Fed did cut 50 basis points, the feeling was that it would be reflationary for assets. But if you notice, since September, whenever that 50 basis point cut took place, yields have actually been going up, and yields have gone up 50, 60 basis points on the long end in the US. And there is some conversation that maybe the Fed has cut prematurely, the economy is reasonably strong, and probably it's not accounting for the fiscal stimulus that is already in place and the inflationary policies of particularly Trump that is going to follow. So a lot of smart investors like Stanley Druckenmiller are short the US long end of the bond market. So that's quite interesting.
Wow. Okay. Rajesh, how bad can it get therefore? I'm just trying to understand the narrative for the first 8 months, or the first 9 months of the year really, was around the strength of the domestic flows, helping cushion any kind of dips and dips getting bought into. Agreed, the ferocity in October is something that we've never seen before. We can't continue seeing this, right? Or do you expect that could happen, that what we've seen in October, we could see something like that happening in November as well in terms of FI outflows?
So my sense is that what the FIs are trying to do is price for the immediate risk that is at hand. I think they will wait for the elections and subsequent policies and all of that. But India was at a new high and an expensive market and a slowing economy. So the conviction and the margin of safety for them to sell was particularly high. So my sense is that first of all, they'll try to price in the increase in bond yields that has already taken place before they pause to see other actions. See, as far as the Indian markets are concerned, apart from the FI selling, which will stop at some point of time, when valuations have corrected adequately to reflect the increased risk, my sense is that economy in India will have to repair itself. We are still in a bull market as far as the economy is concerned. I think our macro situation is still very strong. We are still in a capital expenditure-led economic cycle. So my sense is the slowdown that we are witnessing today will kind of turn around. It's transient, but it'll take time, which means that my sense is that the gut feel says that the upside for the market to reach a new high will take some time. And the markets will have to digest a time-wise correction to kind of accommodate the slowdown that we have had. And therefore, it will take time for it to repair and come back. So my sense is that from an Indian equity market perspective, the new highs could take some time.
Rajesh, the last time that we spoke, you mentioned that something like the real money will be made at the broader end of the spectrum, because that's where the real India story is getting built, earnings growth might happen. That is that place that is the worst hit in the last 1 month. Now, the question is, agreed, valuations were expensive and therefore the hit was obviously going to happen. Is there more pain here? What's your sense?
Right. So I do truly believe that the India story is really happening in the mid-cap and small-cap end of the space. The large-cap earnings growth is sufficient, but I think the mid-caps and small-cap is really where the emerging stories are. You just interviewed one electronic manufacturing company and you see how they have done in terms of growth rates, etc. The valuations, as you point out, were very, very expensive. Even now, when I'm looking at companies, I don't think the valuations are appearing cheap. But that is the opportunity. As this market corrects and it provides more saner valuations, I am also excited that this is the time. In fact, in our morning meeting today, that's what we were discussing, that it will be, as we move forward, it will be an opportunity to buy some of these stocks which are falling, in the mid-cap and small-cap space as you move forward. So we are also on the lookout. But as yet, I don't think we are finding too many compelling opportunities. So we'll wait.
Rajesh, not compelling because of the valuations or not compelling because of the earnings reportage?
Combination of both, but I would say the valuations also are not at this moment accommodative.
Okay, so we have Mr. Satyanarayan Chava with us, and Mr. Chava, I'm coming to you in a moment, but because Rajesh Bhatia, a great thinker of all things markets, including pharma, is with us, I would like to ask him one last question on this space before we start our conversation with you, Mr. Chava. And Rajesh, the question to you is this, that there is a Biosecure Act that has gotten passed. There is a cyclical turn that seems to be happening in contract research development, so CRO and CDMO. How constructive, not constructive are you on Indian pharmaceuticals? I'm leaving out hospitals, diagnostics, etc. So not the wider healthcare bucket, pure pharmaceuticals, CDMO, API, what have you?
No, the entire sector is extremely attractive. By the way, I think even today as we speak, this sector has generated probably 40-50% return in the last 1 year. So it's been a rank outperformer. Whether it is domestic pharma, whether it is, as you point out, the CDMO companies, API manufacturing, or US generics and specialty chemicals. All of these areas are doing extremely well. And my sense is that, of course, we have a lot of winners there in the domestic market, also in the global markets. So we in fact have a dedicated pharma fund, by the way, and we are quite excited over a multi-year period on the opportunity that Indian pharma offers.
Rajesh, just one last question. This Biosecure Act, so much is being spoken about. I'm going to ask Mr. Chava yet again on this. But this Biosecure Act, how big an opportunity could something like this be? Because we've heard enough of China Plus One in various sectors. Now people are talking about the Biosecure Act leading to a China Plus One and others for Indian pharma as well. How constructive or not constructive are you on this aspect? Before we wrap up, Rajesh.
No, I think it's better you ask the expert that question.
That I will. That I most certainly will.
Let him kind of articulate that.
Okay, Rajesh, hang on. Let's hear it from Mr. Chava before we start the Laurus Labs interview with him. But Mr. Chava, just not for Laurus, but for the space at large, how crucial is this Biosecure Act, and when do the benefits start trickling in, sir?
I think the Biosecure Act will certainly benefit Indian manufacturing-focused pharma companies. There are some companies which are marketing-focused. Some companies focused on the manufacturing. The companies with large manufacturing and expertise in complex chemistries, they are going to get benefit. Whether Act becomes a reality or not, but people are started looking at alternatives for their late stage, large volume clinical programs. If somebody needs 100 kg, he will probably prefer to take it to Europe or US. If it is, they need 100 tons, for example. For them, look at Asia, especially India, is a better opportunity for them to put a large volume late stage projects. I think that's very positive for Indian pharmaceutical companies.
Okay, Rajesh, before we let you go, therefore, Nifty Pharma has delivered healthy returns. I heard you say you expect the same can continue, or is it difficult to pencil in a point of time when the incessant selling from FIs continues?
Well, not at the same pace as the last 1 year, but I think over a multi-year period, I think given the valuations have already kind of extended themselves on the pharma side. But my sense is that the earnings growth will kind of be multi-year. So in that sense, I think, you need to be constructive on the pharma sector over a period of time. Also, it's a fantastic defensive to own in troubled times, especially if things really go awry on the global macro front.
That's certainly true. Okay, Rajesh, great having you. Thank you so much to you and yours. A happy festive season, and thanks for being with us today.
Thank you.
All right, that's the view from Rajesh Bhatia, CIO of ITI Asset Management. Now, in conversation with Laurus Labs and Dr. Satyanarayan Chava with us on Laurus itself, though. Dr. Chava, good having you. Thanks for joining in. How would you summarize the quarter? It was a quarter of, I think, ebbs and flows for you, because if I look at the headline numbers, it was a miss on margins, on net profitability, partly even on the top line. But CDMO seems to have turned a corner a bit. So are you disappointed with the fact that the margin uptick is not coming in? Or are you constructive on that, part one? And then, of course, dwell a little bit on the uptick that we've seen in the first vertical that we'll talk about, which is CDMO.
No, these numbers are in line with what we thought at the beginning of this financial year. And we're always guiding our investors, all the stakeholders, that FY25, the first half is we don't expect growth, but second half we expect significant growth. In the Q2, as you have mentioned, the CDMO segment witnessed significant growth. But in Q3, Q4 onwards, other areas also will definitely help us to grow. Yeah.
Okay. So you are saying that API sales, for example, which decreased YOY because of a facility shutdown, will see a reversal in Q3 and Q4?
You are absolutely right. The one block is shut down for modifications. There's another block undergoing modification to suit a particular product for commercial deliveries. So this is planned. So nothing surprising for us internally, Niraj, on this.
Sure. Okay. So, let's talk with the one that didn't shape up, and then I'll talk a bit at length about CDMO, because I really want to focus on that. The street really wants to hear from you on that, as to when does it finally happen. So APIs, planned shutdown, impacting numbers, possibly impacting margins as well this quarter. I hear you say that Q3, Q4 will see a reversal of that. So on a YOY basis compared to last year, you think the API segment will deliver strong growth, or will it probably happen back-ended in quarter 4, Dr. Chava, Because ramping up a shutdown facility might also take some time.
No, we already, that facility came online last week. So that was a planned shutdown. So there is nothing surprising there as well. See, as we have mentioned, our API forte is in ARV and oncology and select APIs in other therapy segments. We have identified a few therapy areas to excel, like oncology and ARV. And you will only see those giving results in FY27, not in FY26 also. So as you are aware, see, we have a very strong R&D team. And when we come into a portfolio, we want to be a leader there. So if you look at, if there are 10 APIs, 100 people can make, and we don't want to get in such segment. So we have identified a segments where India is not focusing much. And India doesn't have much capabilities in that front right now. So those APIs will drive our API growth. And as we have repeatedly mentioned, we don't expect growth in ARV, both APIs and formulations, give or take 100 crores. We expect those ARV segment will contribute 2,500 crores for us in the medium term as well. Whereas our real growth comes from non-ARV, non-onco formulations as well as APIs. And we have a very well-defined plan in place, which we are executing already in areas.
Got it. Yeah. Okay. Fair call. And that you have mentioned. Now, CDMO, sir, improved in quarter 2. I believe you said that you expect to scale in H2 considering the contracts in hand, and CDMO will drive growth in H2 for Laurus. Did I get that correct? Please explain that, sir.
So, as industry, everybody is aware, getting a contract, getting a PO from NCE program now, today, and delivering in Q4 is not a reality. So, to deliver a project in Q4, we might have orders in place, production might be going on. So, we have a very good visibility what we are going to deliver in Q3 and Q4. See, it is not that we have orders only for Q4. I think our efforts of investment, significant amount, both material and resources into the CDMO segment have started yielding results, as partly evident from our Q2 numbers. And the coming quarters, I think, will demonstrate why we invested so much money into CDMO space, why we allocated large resources to projects and all. So internally, all our teams are very excited the way company is progressing in this space.
Most certainly. But still, details. So there are 2 or 3 interesting nuggets that I've picked up from the call, Dr. Chava, which I want to probe a little bit. Okay, let's start with the first one. If you have this confidence about what CDMO would do and how you do not expect anything more than base contribution from APIs, why is it that you are refraining from giving a sales guidance? Is there some uncertainty in the system, or you just want to be erring on the side of caution?
We stopped giving guidance, Niraj. That's the only reason we are not giving. Yeah.
But I heard you say that you will probably give post Q3, no?
We don't want to. See, actually, we guided our investors. The entire financial year, our EBITDA will be closer to 20%. At least it's easy to guess how our Q2 look like for Q3 and Q4. So I think we are very confident that to take our entire financial year EBITDA to closer to 20%. Yeah. We are very confident on that.
Yeah. Okay, I was going to come to that next, Dr. Chava. I mean, and obviously you know the numbers. I'm preaching to the choir, but if you've done 15% average, you need to do 25% average in the second half. Does it start in quarter 3 itself, or is this a trend that you will probably go to from 15 to 20 in quarter 3 and go to 30 in quarter 4? Because in order to clock in that average, simple math, you need 25% average in the second half. How does it happen, sir?
I think you're right. You will see a gradual improvement in Q3 onwards. It's not that magic wand is going to give us huge EBITDA in Q4. It's not that. We see the improvements will start coming from Q3 onwards.
Yeah, which is actually even more constructive, Dr. Chava, from somebody who's watching your business, because that means the exit rate into FY26 is very strong. Now, a lot of people believe that FY25 will be a flattish year. The real magic happens in FY26. If you have a strong exit rate in Q4 of FY25, then does it augur really that well for FY26? So what I'm trying to understand from you, sir, is this, that if indeed that is the trend in your mind about Q3 and Q4, and if you manage to do that, do you have the crystal ball to gaze a little bit beyond FY25 into FY26 as well? Exit rate of FY25, could that be the norm for FY26, sir?
Broadly, I'm not giving
a guidance. Yes.
The CDMO revenues are very bumpy, but we expect significant uptick happens from synthesis business, CDMO business in FY25 to FY26.
Okay, yeah, it will be bumpy, but on an average, you believe that the upticks that you will probably clock in quarter 3 and quarter 4, both on revenues or both on CDMO performance and margins, could very likely be the norm for the year at large? I mean, the average for H2 could well be the norm for FY26 as well. Would that be a fair assessment?
Probably yes.
Probably yes. Again, I'm not pinning you down to a guidance, sir, which is why I'm not asking you numbers. I'm just asking you for the color. Okay, how are conversations like with clients? I've heard this so many times. I'm talking to a couple of your peers as well who are saying that conversations are looking fairly encouraging, even if they may not be closing into deals as yet. How are your conversations, sir, with your clients?
We have seen increased visits by big pharma, which we never expected they will visit. So that is happening. That is a positive step. See, they were able to see the infrastructure in India. They were able to see the technical capabilities of Indian companies. When we looked at their reactions, they were pleasantly surprised that Indian companies can also deliver competitive pricing, large-scale manufacturing, ability to handle complex chemistry. They are pleasantly surprised. That is a positive step for Indian companies who are focused on technology and manufacturing. That is increasing.
Is it resulting in any closure of deals as yet, or are these still at the conversation stage, sir?
I would say at least we were able to get some RFQs based on their visits. We haven't delivered projects, but we have visibility that probably they'll work with Indian companies.
Got it. Okay. Last question, sir, out of time, but on the capacity ramp up and the debt, because I presume you've said that while the current debt is 2,600, you might go higher, but you will not cross the 3,000 crore mark. Is that a line in the sand that you're drawing for debt, part one, or could it expand as you set up more capacities and the equity valuation goes up?
We continue to set up capacities. Right. Yeah. See, that is the decision we took because of the opportunity in front of us. So nobody is asking us to do this, take pains right now. We took pain because we see opportunity. And we continue to invest in capacities this year, next year. But our cash flows will help capacity expansions in the next financial year. And as we guided, we don't see our debt going about 3,000 right now. And currently our debt by EBITDA looks very high because we haven't done well in the first half. But by end of this financial year, we expect our debt by EBITDA also will be closer to 2.5.
Okay, sorry, just one wrapping it up, Dr. Chava. Did I hear you say that debt won't go beyond 3,000 right now? I mean, so are you laying it out for FY25, and could FY26 be a different year on the debt numbers?
No, we don't expect even FY26 the debt go beyond 3,000. We don't expect.
Beyond 3,000 crores for FY26 as well. Okay, fair call. Dr. Chava, this was lovely. Just one final question before we let you go. On capacities as they come on stream, because you have multiple facilities coming up in multiple line items. Just lay it out for us before we wrap up. What is the capacity addition plan? When do some of these come on stream?
We are adding about 1 million liter reactor volume. That will come live mid of next financial year. And we are also adding 500,000 liter fermentation capacity that will come online in sometime end of 2026. That is 2 years from now. That the fermentation. Whereas the API capacity will come mid of next year. So these are the two capacity expansions what we are doing right now.
Okay. And some capacities come on stream, utilization levels improve as orders come in. Dr. Chava, great having you. Thank you so much for taking the time out and being with us today. Really appreciate your time, and festive greetings to you and your near ones.
Thank you, it is nice talking to you.
As always, sir. And well, that's the view from Laurus Labs. Constructive on second half. Margins will average 20% for the year, which means that they expect that the actual numbers on the margins in the second half would be much higher, clocking an average of about 25%. That's all at the time that we have on this edition of Talking Point. Thanks so much for tuning in.
watching NDTV Profit. I am Mahima Vajrajani. Well, Godrej Consumer came out with its Q2 earning yesterday, and the numbers look good as compared to how other FMCG companies have performed. In terms of volume, they did see a growth of around 7%. In terms of revenue, it had an uptick of 2%. EBITDA went up by 5%. Margins have remained stable, while other FMCG companies are facing challenges as when it comes to the margins, and net profit was up around 13%. But to understand the intricacies of how the quarter has gone by, we are joined by Mr. Asif Mulberry, who is the CFO of Godrej Consumer, who joins us now. Welcome to the show, Mr. Mulberry. Right, Mr. Mulberry, my first question to you is that, before I go to the numbers, let's address the elephant in the room. All these FMCG companies have come out with a commentary saying that the urban demand is softening going forward. It had been the case that rural recovery has been happening in the past 2 quarters, but now it's the urban demand which is facing the pressure. So your view on how Q2 has panned out for you in terms of urban demand?
So I think the positive thing is that there are early green shoots on the rural demand, and that is showing some positive sign. There was a time when rural was really lagging urban, and now that has kind of started improving. So that's really positive. Yes, there is a mild stress, I think, building in urban, but possibly too early to kind of read as to what's it on account of, is it short term? Market conditions which people had hoped and which we would hope that would have been significantly improved is still give or take whereabouts there.
All right. So this was on the back of urban demand, but your sense of how the quarter has it been as per your expectations, or you could have done better?
In terms of the top line growth, we are quite happy with the growth which we've delivered in the current environment. We delivered a 7% growth on the India business. We have been targeting a high single-digit growth for India with an aspiration in the medium to long term to kind of start getting more closer to a double-digit. So we're quite happy with the shape in this current environment. Even in our international geographies, we've delivered a good shape of growth. Indonesia delivered a similar growth of 7%. And in the rest of the business, we've taken very conscious actions to kind of bring inventory down in trade. Offtakes have been strong, market sales have been strong. So I think we're happy with the shape of the growth.
Right. Mr. Mulberry, I want to understand that while most companies have seen volume growth of, in low single digits, some have even seen a degrowth in terms of volume. You have seen a volume growth of approximately 7%. So what has set you apart overall?
So I think there have been a lot of actions which have been taken from our end in terms of getting to this growth level. A lot of product interventions which we put in the categories are kind of bearing fruit. We've also been investing a lot in terms of building some of the distribution channels in rural, etc. Those are also kind of bearing fruit. So I think a lot of execution which has gone in over the last couple of quarters are coming together to kind of deliver this performance.
All right. I also want to understand in terms of how the raw material pricing environment is like, because most FMCG companies are facing challenges with respect to raw material prices being elevated, and this is taking a huge hit on their margins. But your margins have fairly remained stable. So how are raw material pricing panning out for the company, and what is the outlook like?
So again, I think for us, it's seeing it in 2 parts. There is an India business and an international business. As far as the India business goes, there is a pressure because we still have a very large personal wash business, soaps business. The palm oil prices have been going up significantly over the last 6 months, and that is impacting the profitability of the soaps business. We've always seen that when this happens, in the short term, margins do get impacted. In the medium to long term, we come back to normative levels because the price increase on the portfolio lags the cost increase. So we do see a bit of a pressure for a couple of months more till the time the price catches up or the commodity prices kind of settle down. So there will be a bit of a margin pressure. Going forward, we managed to kind of use multiple levers of cost saving to kind of hold the profitability. But we could be a pressure which we could see for short term. But it's not something which we're worried about because we know that in the medium to long term, we will be able to get this business back to the historical levels of profitability. And we continue to continue all our investments on growth. So we continue to kind of, we moved around 300, 400 bips higher on advertising. We're making a lot of investments on distribution, etc. All those investments are continuing. And in spite of that, we are able to kind of deliver the shape of P&L. When it comes to the international business, it's a different story because that's less impacted by some of these commodities. And we are on a journey of structurally improving the profitability of the international business. You will see that we moved over the last 2.5 years from a 10% to 13%, and in first half, we've delivered a 16% profitability on the overall international business. We believe there is still a distance to be covered, and we'll remain focused on kind of getting there.
So have you then taken any price hikes in the quarter, or are you planning to take price hikes in the going quarter?
So if you specifically talking about the India business, this has been a flat UPG quarter. Volume and revenue has kind of grown by both by 7%. Having said that, that's because it's been averaged out in the quarter. But going forward in second half, we do see low single-digit price growth coming through, and hence revenue growth should start growing higher than the volume growth. So we will definitely see that impact in second half.
All right. You know, your international business otherwise has done well, Mr. Mulberry, but Africa, US and Middle East sales has declined by 10% in INR terms and was flat in terms of constant currency terms. You know, and this pocket of your company has been constantly underperforming. So what's the way forward to this? When do you expect recovery?
So we specifically called it out last quarter, saying that it will be 2 to 3 quarters where we will kind of simplify the business model. And these are markets in which the interest costs are quite high. In some of these geographies, the interest costs are as high as 35%. It's important to hold less inventory with trade and run an efficient business model there. That's the journey we are on in parts of Africa. So we will see another quarter or two where we will kind of take some of these tough calls, post which I'm quite confident that we should be getting into the growth opportunity, because the fundamental growth opportunity is quite large there. Our brands are very strong. We are market leaders in many categories in which we operate. So we will get back in terms of recovering the growth there. Having said that, some of these actions have enabled us to kind of really expand the profit pool and correct these margins to. We have taken a target of getting to 15% margins in this business over a period of 2 years. Over the last 3 quarters, we're almost there at a 14.5% business. So we're actually ahead on getting to our destination margins, and we will work to improve the margins from here on.
Right. Mr. Mulberry, I also want to understand that it's the era of quick commerce and e-commerce, and I want to understand how e-commerce and quick commerce as a channel is developing for you as a company.
No, so we work very, very closely with both quick commerce, e-commerce, modern trade. So with all channels, we work very, very closely. We have channel-focused teams who work very closely and drive the joint agenda in terms of our brands. So we're quite happy in the way it is shaping and the kind of opportunity it gives us on some of our brands. It's really nice.
Welcome back. Well, we are now taking stock of the markets, and it does seem like the selling has intensified at the moment. Not only are we looking at the benchmark indices trading at, days lows, in fact, we're seeing intensified pressure when it comes to stock-specific action. I'll start off with the Nifty, which is in fact looking at a cut of around 0.8%. We have lost out on 24,300 as well, in fact, inching towards 24,200. There are now all sorts of numbers being put out when it comes to 24,000 in this case. Do remember that over the past 3 days, we were testing 24,400 to 24,500 on the lower end. That it seemed to be